Here are your top stories. The yen extends declines after new BOJ Governor Kazuo Ueda says he will not hesitate to ease more if needed, emphasising that policy could change during a monetary policy review. Amazon takes the shine off big tech, warning revenue growth for its cloud business is slowing and sending US futures lower. Intel points to a stronger second half. Plus, NatWest's first quarter profit beats estimates as rising interest rates help the British lender. We're going to listen in to highlights from CEO Alison Rose's interview with us later.
Tom, let's look at the futures. Now, it has been quite a busy week in terms of earnings. We look today, of course, at the tech. That's giving a nice little lift across the board, certainly in certain parts of the markets. And we're looking at the FTSE futures gaining 0.3%.
Yeah, as you say, the tech story really giving a lift, particularly for the Nasdaq yesterday, in terms of the best performance as well for the S&P since about the first week of the start of this year. It was a storming session over on Wall Street yesterday. There are question marks, as we said in the headlines, around the prospects for AWS, the important profit driver for Amazon in the quarters ahead, but it is central bank policy as well, front and center. And we talk about the yen story, significant weakness there coming through on the back of the presser and the decision to stay pat, but of course a review being launched and guidance around interest rates as well being scrapped, at least for now. We keep across that story and get analysis from Kathleen Hayes in just the next few minutes, who is outside the BOJ for us in Tokyo. The CAC currently earning and gaining 0.2% over in France. Some upside across the French index. You did see growth coming in stronger than many had expected for that country, suggesting that maybe those recession concerns around the Eurozone have been overplayed. We can keep across as well the inflation data, 6.9% CPI for France, coming in slightly above the estimates. Over in Italy, getting 0.3%. Here in the UK, up 9 points. And over in Spain, a gain of 0.1%. Let's check in then on the yen and give an update there in terms of the pressure coming through for that currency. Is this optionality that the BOJ governor is giving himself, saying he will not hesitate, they will not hesitate at the BOJ to add further easing if needed, but also saying that during this policy review, there is the option as well to change policy, and of course we focus in on yield curve control. Currently the yen down 1.6% versus the US dollar at 135. Is 136 the next level then for dollar yen? Futures in the US pointing down by 0.2% when it comes to Nasdaq futures, of course, tech heavy on some of those concerns being flagged by Amazon. The 2-year currently back above 4%. You saw yields moving higher yesterday on the back of some of that data coming through in terms of jobless claims, stronger there. Question marks around the growth prospects, but the banking sector remains vulnerable in the US clearly, and we know that regulators are working, according to Reuters, on a plan for First Republic. $78 a barrel on Brent. That is a gain of 0.6%. Fran.
Tom, if we dig a little deeper into the sector, so there are 20 groups actually making the stock 600. Most of them are on the up, and actually it seems pretty range-bound. So a lot has to do with earnings. A lot of the focus is not only on margins, but forward guidance. We have only 5 groups on the down. The biggest loser, utilities, down 0.4%. The biggest gainer, construction material, actually gaining a 1%. And then we have auto parts, technology, and financial services amongst the biggest gainers, Tom.
Okay, from the sectors then to the biggest central banking story of the day. The Bank of Japan then scrapping its guidance on future interest rate levels and calling for a long-term review of its policies. Let's get more then with Bloomberg's global economics and policy editor Kathleen Hayes, who's been across this story from day one, outside Tokyo, outside the BOJ, in Tokyo. Kathleen, the takeaways then on what we've been hearing on this presser.
Well, I think it's it's very important because there was a lot of speculation this week. I mean, every day that Governor Wade went to the Diet, went to Parliament, and testified, he hit on something. And there were news reports about things like Sankey over the weekend saying that the policy review would be a long one, right? Those kinds of things have been confirmed, and we have important information. The fact that he said that they could still change policy during the policy review itself is very important, right? Because some people said, oh, it's going to be long, so that means that they won't do anything substantial on policy. Well, we don't know. And I think it makes it very clear in different ways that they are watching the numbers, and they still do expect inflation to peak and then start coming down. They did, however, increase their inflation forecast for the core, take out food and energy, for 2023 and 2024. And he says current inflation is high, could last for a few more months. And he also said that longer term, their view of inflation could change. I think this is so important right now because they don't want to make a mistake, and he's made that clear. And he was there in 2002 when his 1998-2005 term, when he dissented against a very important decision to raise rates. He said he wanted to see how things played out, and he wanted to see more numbers. And in fact, the BOJ had to reverse course on that interest rate. They had moved too soon. And there's lots of people inside that building who lived through that. They've seen the BOJ start moving stimulus too soon, not be patient, and have to keep fighting it for so long. And that's the camp he comes from. So I think a lot has to do with inflation when it comes to yield curve control. It's still an open book. Too many people think that right now it's a good time to move because the yen's steady, bond yields are steady, and there's even someone on with us, Ri Nishihara, earlier today from JP Morgan Securities, who thinks they could still make a big move in June or July.
Kathleen, thank you so much. As always, of course, this is the talk of the town. Mr. Ueda saying he's paying attention to the balance sheet between the positive effects and side effects of easing. Our very own global economics and policy editor, Kathleen Hayes, in Tokyo for us. Now, to talk more about the yen, but central bank policy in general, we're also joined by Ben Guttridge, Director of Model Portfolio Services at Invesco. Ben, thank you for joining us. Look, when you look at the Bank of Japan, a lot of the focus, of course, on policy change still possible under the review, but actually they're keeping the policy pretty much as it is with, a disclosed result bit by bit on what they could change going forward. How does this fit into the wider narrative for central banks?
Well, the Bank of Japan isn't necessarily isolationist, but it certainly has had like a history of different inflationary challenges, and it certainly likes to sort of keep us on our toes. And like the extraction from a yield curve control policy is clearly very difficult. If you want to do it gradually, then the market anticipates that and sort of sells loads of bonds, and the Bank of Japan has to buy more than it wants to. So I think we sort of probably have to be alert to surprises there, and that probably isn't the case for other central banks who want to be more explicit or attempt to be more explicit about their sort of interest rate path and interest rate policy. So I think slightly different dynamics, but it's certainly more of a hawkish thread there relative to developed markets who I think were sort of nearing very close to the end of their sort of hiking cycle.
And Ben, we want to get your views on the other central banks. Before we go there, let me get your views on the equity space within Japan. 10% gains year to date for the Nikkei. That's outperforming Europe, it's outperforming the US today, 1.4% on the Nikkei. Warren Buffett is piling into Japanese stocks. Do you want to follow that rally?
Well, I don't think we do want to get on that train at the moment. I think a lot of that will have to do with a reopening China and the ties that, the sort of cyclical ties that Japan does have with China. But I don't think the China recovery story is sort of a surge in imports. It's more of a domestic recovery story. So I don't think that sort of cyclical element that Japan has enjoyed would persist and may indeed fade. I mean, not talking zero weight to Japan here, but sort of a modest underweight on the Chinese delta to global growth, sort of disappointing, and Japan may suffer in the face of that.
But Ben, again, when you look at the BOJ actually committing to stimulus for now, is there a worry that there's some kind of policy mistake coming from the Fed?
Yes, I think there is always a risk of policy mistake, particularly around these points of inflection. The anticipation, I think, is that the Federal Reserve will take note of both moderating, although not capitulating, inflationary pressures, and of course the withdrawal of lending from the banking sector, particularly sort of among small, medium-sized banks, and therefore that we do anticipate, maybe one more hike and then a pause and a communication of a pause. I guess the potential mistake would be on the hawkish side at the moment, and the fears about inflation. Obviously, they want to sort of tackle this menace, and if the higher for longer narrative is more of a sort of a reacceleration more than one hike, 2-3 hikes, then you're thinking about a more dramatic economic downturn, and of course what that could mean for the banking sector and other unknowns in the financial sector that have been dependent on lower rates. So that would be the risk. But it's not our core view.
Yeah.
We get that. Sorry.
And no, just on the banking sector, a reminder, of course, for viewers that you've had now 2 straight weeks where they've had to tap that emergency lending facility from the Fed, that those emergency loans are coming through for the banking sector. And then in terms of loans from banks to the broader economy, falling to the lowest level since 2008. So the stresses are clearly still there.
Yeah, I mean, these unique challenges are multiplying, aren't they? So
is there a systemic risk?
Well, I mean, I was sort of a bit tongue-in-cheek there. I don't consider it to be... there is a systemic risk, but I don't expect it to materialise. I think the policy choices that the Federal Reserve is taking to provide the necessary liquidity to the banking sector should be enough to instill confidence. And they're alert to these risks, and yet more policy choices could be taken to shield the banking sector or shield depositors from the threat of increased bank failures. But I guess as we've seen in the equity market in recent months, absent sort of a systemic failure, but bank challenges, it's the banking sector that maybe does some of the Federal Reserve's work in terms of anchoring growth and bringing down inflation, and therefore you don't need to see interest rates peak, or the interest rate peak can come down, and that's sort of generally a good thing for...
And hence your call that you get another 25 basis points and then pause from there from the Fed.
Yes, correct, yes.
Okay, Ben, fantastic stuff. We're going to get more from Ben, more of your calls and more of your take on the earnings picture just in the next few minutes. Ben Gutteridge from Invesco staying with us. Coming up, Amazon jolting investors then as executives reveal growth in the cloud unit is slowing. The moves in those markets in the stock was pretty dramatic. Gains and then a loss on the back of the comments from executives. We're going to have the details next. This is Bloomberg.
CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
Welcome back to the Open, everyone. 13 minutes into the European trading day. The focus firmly on earnings. The focus, of course, also firming on tech stocks. We saw a nice little lift with the NASDAQ. And then a lot of the focus also shifts to data from the U.S. Now, Amazon warned of a slowdown in its cloud computing business after reporting results, jolting investors who hoped the division could actually weather the tech downturn. Well, joining us now is Matt Bloxham of Bloomberg Intelligence. Matt, so good to see you. So what stood out to you in the Amazon results?
Yeah, I mean, certainly the magnitude of that slowdown in April in the cloud business, 5 percentage points slower, so about 11% annual run rate compared to the 16% in Q1. But I think also, some comments from Andy Jassy about the long runway he still sees in cloud. He said that 90% of global IT spending is still on-premise, and that's going to move ultimately to the cloud. So still a huge opportunity, and they're essentially investing in AWS for the long term, building strong relationships with their customers, happy to take near-term revenue pain to help those customers optimize their costs, knowing that in the long term, those relationships will help them to kind of build the revenue. So yeah, I think that was important. But I think also, some optimism about the consumer business, the online retail, where obviously it's been tough. They overspent on fulfillment and capacity. They've reined that in. I think there's some optimism that even though the top line's not great, only growing 2 to 3% annually, that the margin could improve through the course of this year as the effects of restructuring start to come through.
Yeah, well, they overhired as well, didn't they? And
yeah.
now they're winding some of that back. When it comes to Snap and Intel, for Snap, advertising, it's a different picture to Meta. Meta came through strongly with digital ad sales. Slightly different picture for Snap, and then the importance of the chip sector and that demand for Intel. What did stand out for you, Matt?
Yeah, that's right. So Snap, first time they've seen revenue decline since they're a public company, down 7% year on year, and they're expecting them down around 6% in the next quarter. To me, Snap's a business that's just kind of struggled to kind of find a robust business model. They've got 380 million active users, and yet on $1 billion of quarterly sales, they barely make any profit. So that they've been going through some changes to the ad technology stack and the proposition they're taking to brands, but it's still not delivering enough money to make the numbers work at the scale they've got. So I think there's still a lot of head scratching to do there as a business, and I think that's why you saw the shares down, close to 20%. Yeah, Intel, I think expectations amongst investors are pretty low. They've had a difficult time because of the amount of inventory their customers had built, so that was slowing incremental demand. I think they feel like they're coming out the back of that, but the near-term pressure on that business is still pretty strong. So I think although the shares rallied, I think it was a bit of a relief rally that things are difficult for them, but not quite as difficult as people expected them to stay. And there was some optimism in what management said, looking beyond the very immediate quarter or two.
Yeah, and the view from some analysts that it won't be until 2025 that we'll really see whether that investment plan and the restructuring has actually paid off for Intel. Always great and insights and analysis across these tech earnings. Matt Bloxham from Bloomberg Intelligence, thank you. Let's stay on the earnings picture then and get back to Ben Gutter, who's Director of Model Portfolio Service at Invesco. Ben, do tech stocks still look attractive? Do they look attractive to you, or are valuations starting to give you pause for thought?
Well, I do think they look reasonably attractive, certainly on a relative basis, and given the backdrop that we're dealing with, I think of going into a more challenging growth environment and one in which inflationary pressures can moderate. It's a bit of a story from sort of COVID and into COVID is of sort of falling bond yields or sort of stable to lower bond yields, secular growth, and that sort of duration, higher quality trade that I think has some legs through the remainder of the year. But over the long term, you know, these are sort of secular growth stories that can continue to disrupt. So, yeah, in favour of the tech sector, the loosely called tech sector.
So loosely called, are there parts of the tech sector that actually looks more attractive? We still don't really know what to do with AI. I mean, we also played around with ChatGPT, and I have to say, talk nonsense. I think we're still working for like a different channel, actually, if you look at ChatGPT. Does this get better? Does it really transform everything we invest in?
Well, that's a very big question, and I'm not sure I've got the perfect answer for you. But in terms of the investment strategy, look, I mean, it's... I'd like to be really exciting and innovative here, but those sort of big, high-quality tech names, you know, dare I say, the quote-unquote sort of FANG-type businesses, you know, with stronger balance sheets, greater visibility on revenue, and as I say, this sort of secular runway for growth, you know, do look like they're in something of a sweet spot given the conditions that we're in. But of course, a re-acceleration of inflation, which is a material risk, and hawkish, or as we talked earlier about a policy mistake, you know, those sorts of stocks are going to get clobbered. So, you know, we don't want to be pushing too hard on it, but on balance, those well-understood names, Amazon's, Microsoft's, dare I say Meta, those are the things that look in reasonable shape from here.
Ben, thank you so much. As always, Ben Guttridge, Director of Model Portfolio Service at Invesco. Now, in China, the Communist Party's Politburo said the country's economic recovery needs continued fiscal and monetary support. So I think let's get straight to our first word reader, Sam Etienne. Sam?
Morning, Francine. You're quite right. In China, the Communist Party's Politburo said the country's economic recovery needs continued fiscal and monetary support. It also warned that domestic demand is insufficient. The Politburo is a top decision-making body led by President Xi Jinping. And House Speaker Kevin McCarthy stepped up his demands for President Biden and Democrats to avoid a debt ceiling crisis. McCarthy told Bloomberg TV they should embrace the plan that House Republicans passed, one that calls for cuts in federal spending. He said the Senate's done nothing and the president is ignoring the problem. And new data shows U.S. economic growth slowing and inflation accelerating, even before the brunt of any credit crunch stemming from recent bank failures. GDP rose an annualized 1.1% in the first quarter, notably less than the median forecast of 1.9%. Meanwhile, the Fed's preferred core gauge of prices picked up to 4.9%, highlighting the challenge of taming inflation. That's global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Samuel Etienne, and this is Bloomberg. Tom, Francine.
Sam Etienne here in London. Thank you. Coming up, we're going to take a look at your stocks on the move, including NatWest, which plunges despite posting a first quarter earnings beat. Stay with us. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, you know, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to the Open, everyone. 23 minutes into the European trading day. A lot of the focus, of course, on what happens to Amazon at the Open. A lot of the focus is also on technology stocks. And then there's a Bank of Japan, as Ben Guttridge was saying, always a bit of a curveball when it comes to BOJ. Now, let's also take a look at some of the events we're following today. At 10 a.m. UK time, we'll have Euro area fourth quarter GDP. That's as recession appears to have been avoided and sentiment stabilizes. At 11:30 a.m. UK time, we'll get a rate decision from Russia. The central bank is likely to keep the policy rate unchanged at 7.5%. Later this afternoon, we'll have Germany CPI. Economists are expecting the EU harmonized rate to show prices rose 7.8% in the year to April. Finally, 1:30 p.m. UK time, we're out for US CPI, PCE actually, inflation data. So let's also get your stocks on the move with our Bloomberg equities reporter, Joe. I know you have some really good equity movers for us. What's on your mind?
That's right, Francine. So we're starting looking at NatWest today, getting hit pretty hard at the moment, down around 5%, the worst performer on the FTSE 100. And analysts are pointing to the net interest income, which is weaker than expected. They're saying this is basically due to deposit migration as people chase those higher rates of interest. Kind of not surprising, given a lot of the NatWest flexible saver accounts only offer about 2%. Some of the challenger banks now offering 4%, and people are starting to move their money out, and that loyalty to their older banks is not holding up too well. The staffing costs have also jumped due to rising wages. But on the plus side, the loan loss provisions a bit better than expected. But as I say, analysts are looking at that deposit migration at the moment.
Yeah, come on, NatWest, up your game. Give savers a bit of respite. Give them more than 2%. What's happening with Numis, Joe?
So Numis is the one that really caught my eye today. This stock absolutely rocketing, up 67%. Deutsche Bank announcing a surprise takeover for the company. That was at 350 pence a share. Deutsche Bank saying that this will help them to unlock deeper engagement in corporate client activity in the UK and build a leading force in the city of London. So it is kind of a bit of a punt on the UK stock market as well. There's been a lot of doom and gloom. Numis themselves have warned of a bit of a slowdown in trading, but definitely a bit of a boost for the city of London today, I think.
Yeah, we're drinking less. Remy Cointreau, actually weaker than expected sales.
That's right. So Remy, another one that's dropping. Fran, this one was down around 7% last time I looked, now down 5.7%. So they are warning of a strong sales drop in the US in particular. They say it will recover, but that won't happen until the third quarter of this year. They have been pumping up their advertising spending. They did a glossy ad campaign with Serena Williams during the Super Bowl. That not yet having an impact, though. China looking a bit stronger. That's a big cognac market for them. That's improving given the reopening. But all eyes are on the US, where those sales are continuing to weaken after the pandemic. As I say, that one getting hit in Paris.
OK, let's see if they can serve up a win with Serena Williams. See what I did there, Joe?
Excellent.
Very good.
Easton, thank you, Francine. I'll take that.
Very good.
Thank you. Joe Easton with Stocks to Watch. Thank you very much indeed. Coming up, dovish debut, new BOJ governor. Kazuo Ueda keeps stimulus measures in place while calling for a long-term review of policy. The yen is the currency to watch, down more than 1%. We get the details. This is Bloomberg.
of all American women in opposite-sex relationships now make the same or more than their husband. That's a record high. According to a new report by the Pew Research Center, a third of U.S. women are in egalitarian marriages, making roughly the same as their husbands, and another 15% of them are the breadwinners. Women with college degrees and no children, as well as Black women, are even more likely to make more or the same as their partners. But not everything is a bed of roses. Working wives still carry most of the weight of unpaid labor. Women in egalitarian marriages spend almost twice as much time taking care of the home or a loved one, while dedicating less time to leisure.
Women are continuing to go out in the formal labor market and contribute and are still bearing all of the load and responsibility that disproportionately falls on them in terms of family care.
During the pandemic, in the wake of school shutdowns, the height of the childcare crisis pushed nearly half of American women out of the labor force, a trend that's yet to be reversed.
Women are just really struggling to meet the care needs of their family, and at the same time are really, really leaning into the labor market. And I don't think we've seen this before in history, to be honest.
Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. The yen extends declines after his new BOJ governor, Kazuo Ueda, says he will not hesitate to ease more if needed, emphasizing policy could change during a monetary review. Amazon takes a shine off big tech, warning revenue growth for its cloud business is slowing and sending U.S. futures lower. Intel points to a stronger second half. Plus, NatWest stocks slide on weakness in net interest income and a lack of upgrade to its guidance. We heard exclusively from the Chief Executive Officer, Alison Rose.
Okay, let's check in on these markets then as we weigh up, of course, the earnings front coming through with the earnings warning from Amazon around its cloud services business. Intel working through some of those inventories and pointing to a stronger second half, as we've been touching on. The benchmark currently flat here in Europe after a very, very solid session over on Wall Street. The S&P getting to levels, the highest levels it's seen since about the first week of the year. The DAX currently gaining 0.2%. The FTSE 100 now down off 0.2. NatWest will certainly be a drag there. Worth mentioning that French GDP came in stronger than expected, pushing back arguably against the narrative that the Eurozone is going to be crumbling into a recession. And talking of the growth dynamics, arguably the Fed getting and putting itself, the data pushing the Federal Reserve potentially into an area where a policy risk, a policy misstep, is more of a risk, given what is happening around the stresses on the banking system, but a still resilient jobs market and inflation remaining high. PCE deflator out later this afternoon. Let's swap over, see how things are looking out across these sectors then. Banks under pressure, again, because NatWest is part of the play there. Banks down as a sector by a full 1%. Basic resources also low by 0.7%. Top of the list, though, construction and materials up 0.8. Tech also, of course, the handover from the US lifted currently the sector here in Europe by 0.6%. But the focus on the FX space is squarely on what is happening with the yen, currently down 1.2%, just pairing a little bit of the weakness on this line coming through from the Bank of Japan Governor Ueda, saying that the chance of normalization during the review period is not zero. This is a red head crossing the terminal then. The BOJ has and will plan and is starting the process of a review of policy, and the Bank of Japan governor giving himself and the team their optionality around adjusting that ultra-loose monetary policy and yield curve control by saying that the chance of normalization during the review isn't zero. He'd earlier said that he would not hesitate, the BOJ would not hesitate to add easing if needed. Fran, currently the yen at 135, down 1.3%.
Yeah, joining us now is Bloomberg's Christina Kino. Christine, great to see you. If you look at yen and some of the surprises, and we're still following, of course, that press conference live and in full, is it going to be left behind?
Well, that is definitely the risk, Francine. And I think there was a lot of hope among market participants that with the changing of the guard at the BOJ, we'll also see a change in their approach to monetary policy. Clearly, that's not the case. And really, when you think about it, that's not really the Bank of Japan style. They really want to proceed with a lot of caution, very slowly, considering this policy rather than kind of abruptly changing it just because the Bank of Japan governor has shifted. But it is quite interesting. I think Tom nailed it on the head when he alluded to the fact that the Bank of Japan really seems to want optionality more than anything else. I think, they are probably open to the idea. They recognize that they are behind in terms of the tightening cycle globally. But I think they just don't want to paint themselves into a corner, especially if things start taking a turn for the worse in the global economy at the second half of this year.
Meanwhile, for the Fed, the situation seems, if not perilous, then certainly more challenging. When we look at the data and weigh up the data that came through yesterday, the jobs market remains pretty tight. Inflation is still high. Question marks about growth. The bank system, clearly the stress is still there in terms of the tapping of emergency lending from the Fed. Does May still, is it still locked in? Is there any sense in pricing in cuts by the end of this year, giving that mix of data?
Yeah, I mean, I think there's really a question of which Fed are we dealing with here? Are we dealing with the May Fed? Or are we dealing with the future Fed? I think for the May decision, I think that is pretty much nailed on. Still the idea of a rate hike, especially after yesterday's mix of GDP and inflation indicator data. And we're going to get more later today, which is the Fed's preferred inflation gauge. And I think that really drives home the point that inflation pressures are here to stay. Now, if we're talking about the Fed in the future, later this year, that's a completely different story as far as the markets are concerned. I mean, we are seeing still those expectations for rate cuts by the end of this year. No one has said that that's kind of the base case, but the fact that those are persisting, and especially because we've seen as well the growth slowdown piece yesterday, it does kind of bring up again all these fears of stagflationary sort of environment. Certainly brings up again the fact that Fed economists themselves are seeing a mild recession toward the end of the year. So it's a bit of a bifurcated perspective in the Fed at the moment, I think, as far as markets are concerned.
Yeah, Christine, I find it very odd because, earnings are pretty strong overall. Actually, if you look at the economy, it's holding up, but then we have all of this talk about something ugly coming. So I don't know whether it's a mismatch that we've seen in the past and what that leads to in terms of equity.
Yeah, quite interesting, Francine. You've seen a lot of kind of future caution from companies, even as they report beat after beat. And I think that just really speaks to the uncertainty that's brought on by the broader macroeconomic environment. We do have uncertainty when it comes to the policy path, uncertainty as well in terms of the health of the consumer in general and how demand is going to hold up. And you really just see companies, getting great results, really. It's mostly been a beat, but also kind of preparing themselves, just kind of saving up that firepower in case there's something that kind of turns worse toward the second half of the year. And again, I think that all just kind of gels with the assessment from various corners that consumers probably going to be weaker in the second half. We're probably going to be seeing more recessionary signs as well. And so you really see kind of companies saving essentially for a rainy day, when they really need to kind of rein in those costs and keep the budgets tight.
Is it too early to start to bet, when we talk about recession risks and growth risks, is it too early to start to bet on a Eurozone that actually posts some resilience? You had the GDP data coming through from France during a period where you had all that industrial strife, and yet you had some growth coming through for the first quarter. Is the Eurozone looking a little bit more resilient than maybe some people had thought?
Yeah, I think that has been a bit of a green shoot, silver lining story so far this year. It's just the fact that the Eurozone economy has held up really well. I think that has to do, of course, with the fact that it was a milder winter. We're seeing kind of prices for energy pull back. I think that was a big risk factor for the Eurozone heading into 2023. And we're seeing now that the worst case scenario is not coming to fruition. And as you say, Tom, we've seen industrial strife in some countries, but that hasn't made quite a dent yet. And I think that's why we've seen European Central Bank officials coming out on the more hawkish side of things and really kind of expressing that confidence that they have room to raise rates, especially because, they are behind the Fed when it comes to that tightening cycle as well. And so they have a lot of room to make up for. And I think the economy will let them do that.
Christine, what else are you focusing on your blog today?
Well, a lot of stories in the UK, of course. Big day for bank earnings again. I think what we've seen this week is quite the trend of banks in the UK, particularly remaining quite resilient. We've heard from a lot of them just reassuring investors that the UK really is kind of in a unique place when it comes to the banking turmoil and the after effects of that. It is quite insulated, or at least compared to the US anyway, from that deposit outflow. Big question marks, though, over just the gains that they've enjoyed when it comes to higher rates and that net interest income that we've seen improve across the board. But of course, consumers asking, when are we going to get the benefits of that as well when it comes to higher deposit rates and whatnot? And, you know, I think a lot of banks still trying to preserve that income, trying to stay competitive, but certainly the clamor for higher rates for consumers growing louder with this round of bank earnings.
Yeah, and NatWest being punished, even though they posted a beat on earnings, currently down 5.2% on that stock. Christina Kino walking us through the big moves across these markets. Talking of NatWest, shares, as I mentioned, plunging on weak spots that analysts are zeroing in on, overshadowing that profit beat. We're going to hear exclusively from the CEO of the bank, Alison Rose. That is next. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The outline speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Welcome back to the Open. We are 42 minutes into the European trading day. European stocks just holding to gains of about 1/10 of a percent. The FTSE 100 now down, though, by the similar amount, down by 10 points. There's no clarity, frankly, when it comes to the Federal Reserve in terms of the data that it's presented with. Yes, markets are pricing in that hike in May, but the challenge around passing the data in terms of the jobs front on one hand, the strength there versus the strains in the banking system really points to the challenge there for the Federal Reserve. The US futures, S&P E-mini is currently down 0.3%. Of course, the yen remains in focus for us today. The first BOJ meeting for the new governor, of course, awaited. Currently, the yen down 1.3% as he stresses the options around further easing and changes, though, also potentially around policy during the review period, saying that those changes are not zero. And the banking sector currently down 0.7%, one of the biggest losers across these sectors. Part of that is down to NatWest. Shares sinking in early trade after the lender sees weakness in net interest income and failed to update its guidance. That's despite the British lender posting a first quarter earnings beat. NatWest Group CEO Alison Rose told Bloomberg exclusively she still sees short-term headwinds.
The outlook remains a little bit uncertain. We're still in challenging macroeconomic times with rising interest rates. We clearly benefit from those, but also inflation remains high, but starting to come down. So still pretty tough, I think, but we are seeing positive signs going forward. We've had good data from our recent PMI report showing business confidence coming back, low levels of impairments. You know, businesses and households are proving to be very resilient and performing well. So we remain optimistic about the future, but obviously, clearly, there are still challenges to navigate.
What was your experience of the month of March?
Yeah, I mean, the market disruption was very idiosyncratic, but obviously it does cause concern. I think for banks like SVB and Credit Suisse, they actually have very little recognition for the UK consumer. So we saw very little disruption caused to consumer behaviour and business behaviour caused by that market disruption. What we did see in the first quarter was our deposits go down by about 2.6%, but those were largely expected. We saw £8 billion more paid in tax by our customers in Q1, and sensible behaviour by customers paying down debt. But overall, that market disruption really didn't translate into concern with the UK consumer or UK businesses who are our customers, because those names don't really resonate on the high street here.
But what lessons have we learned about bank runs in the 2020s where money can be moved so easily? Do you think there needs to be a change in terms of regulation or policy of how we plan for the future when there is a more UK-centric focus to any turmoil?
What this tells you is no different actually to, historic, that if confidence and sentiment is affected, it can really affect customers and cause concern. I think the really important thing is the strength of the bank and how resilient it is, particularly if I look at our position. But, people can move money much more quickly now, online and digitally. There's lots more choice, lots more competition. So I think confidence is really important that we continue to maintain that. And I think the level of regulation that has been put into the banking sector since the financial crisis, particularly in the UK, has seen really robust balance sheets and resilience, which means you can cope with this market disruption.
Of course, a lot of the focus has been on the banking sector, although the UK seems to have weathered the storm much more than others because we didn't really have a flight of deposits. Now, what's interesting when you talk about the flight of deposits, remember 4 days after Credit Suisse was taken over by UBS, there was a lot of concern about Deutsche Bank. The Bank of France governor, François Villeroy de Galhau, has now joined regulators in calling the CDS market, which is where we had a lot of the hotspot for Deutsche Bank, so the credit default swap market, to be reformed. He basically says that there's a lack of liquidity in this market, which is why we saw these crazy moves. He says its opaqueness caused an undue episode of financial distress affecting Deutsche Bank. Now, let's get straight to the Bloomberg Business Flash. Here's Samuel Etienne with the latest. Hi, Sam.
Francine, Amazon reported strong first quarter results with its outlook range also topping estimates. It sees net sales for the second quarter at up to $133 billion. But it says cloud unit growth in April is running lower than in the first quarter's pace. Amazon has been working to streamline its businesses amid slowing sales growth in online shopping and web services. And Intel shares jumped after the chipmaker promised a recovery in the second half. leading investors to look past a disappointing forecast for profitability in the current quarter. The company predicts a return to free cash flow in the second half and says gross margins should begin to widen. Intel also painted a more optimistic view of the broader PC industry. And Snap plunged in late trading following its first ever decline in quarterly revenue after making major changes to its advertising tools. Sales fell 7% to just under $989 million. That missed the average analyst estimate of $1 billion. Economic pressures and the company's product changes are expected to also weigh on the current quarter. That's your Bloomberg Business Flash. Tom, Francine.
Sam Etienne in London, thank you. Now, back to the earnings picture with a focus on autos. Mercedes says its order backlog will support sales in the coming months as the global economy slows. CFO Harold Willem spoke with Bloomberg a short time ago.
For sure, we are operating in a global market in a very competitive environment. I mean, you just named it before. So we look at that, very, very carefully. And want to protect, however, the pricing, again, based on the product substance, on a cautious supply, to the markets, and not, pushing volume into it. I think that is a recipe to protect the pricing also moving forward. However, we are not ignorant of what's going around us and take measures as need be.
And on that product substance, obviously Mercedes-Benz is, perhaps the oldest car manufacturer on the planet. You have perfected the internal combustion engine. For EVs, there's a lot more competition, particularly in your biggest market. How do you stay competitive there? That is a region where you had to cut prices. What are you seeing for the EV price war in China, and what does Mercedes have to do to stay competitive there?
We all, as a management team, spent the last weeks quite considerable amount of time in China. And what is our takeaway from there? Yeah, definitely, it's extremely competitive. But the center of gravity in terms of motion is really in the lower end, in the mass market of the BEV. That's where you can see very, very high level of price dynamics, I would say. Our focus, as you know, is on the top end.
And are you seeing any effect from the Tesla price cut specifically on your EQAs and EQB? Has that dented demand?
Definitely at the lower end, there is a higher level of pricing dynamics, which we watch and we serve. We had, I think, a good run also in the first quarter on the BEV side. Overall, you could see with the numbers that we could double the BEV vehicles in the first quarter 23 compared to a year ago. And in the numbers, you can see at the same time that we could hold also margins. That also includes, I think, healthy margins on the BEV side, but structurally lower than on the ICE.
That was the Mercedes-Benz Chief Financial Officer, Harold Willem, speaking to Bloomberg's Oliver Crook. Now, coming up, we've got inflation data out of France and Spain. What will the numbers mean for the ECB's rate path? We discuss that next, and this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Open, everyone. 53 minutes into the European trading day. We're off the day's highs. A lot of the focus, of course, is on Amazon, as Amazon Cloud, that warning taking some of the shine off some of the robust earnings elsewhere. Now, France's economy rebounded at the start of the year, while Spanish growth exceeded expectations, reinforcing belief that Europe will continue to avoid a recession. Let's get straight to Stockholm, where Bloomberg's Maria Tadeo has been speaking to finance ministers. Maria, great to speak to you. So break down the numbers for us.
Yes, Francine, and we have been speaking to finance ministers here. Everyone on countdown mode to some extent. It's not just on Bloomberg TV that we wait for this GDP figure to hit in about an hour from now, first quarter for the euro area economy, but also finance ministers gathered here. But as you say, Francine, we've already had a preview from the French economy, second biggest economy, and also the Spanish one. And you look at the GDP data out of both countries, it was actually stronger than expected, which may feed into the euro area number in an hour from now, which again feeds into the European Central Bank narrative, because you could argue it shows that the economy is resilient and has been able to withstand the turbulence that we saw from the banking sector, but also this hiking path that the ECB is on. When you look at inflation, for instance, if I may just very briefly, the Spanish number, we know that a lot of people in markets really look at this number, this correlation between the headline number and the core figure. Headline inflation is still a problem, but when you look at core inflation in Spain, it was actually down, which again may be interesting when it comes to the ECB action that we're going to see next Thursday.
And talking of ECB action, you've been speaking to the IMF, a bit of a push there, maybe, around higher rates. Is this a nod to the hawks within the Governing Council at the ECB?
Yes, Tom, and we happened also to speak yesterday with Alfred Kammer. Of course, he is the head for the Europe unit at the IMF, and you know he was very candid, and he said, you know what, this point, the economy needs still further hikes. Inflation is not under control, and the worst thing that you could do is to go lose before you're able to get to that target. Let's have a look.
What is clear is that monetary policy needs to tighten, and monetary policy will need to stay tight for longer in order to bring down inflation. Why is that important? Because the worst thing you can do when you fight inflation is loosen too early or pause too early, because that will require a second attempt to tighten, and that will increase the costs of the disinflation effort.
Okay, Maria Tadeo, thank you, bringing us the latest in terms of the inflation data, the growth data preview as well from Stockholm, and of course sound there from the IMF. Your stock markets here in Europe currently up 0.1%. Futures in the US, though, lower by 0.3 on the S&P E-minis. That's it for the European Market Open. Surveillance Early Edition is up next. This is Bloomberg.
replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. The yen extends declines after the new BOJ governor's dovish debut. Kazuo Ueda says he will not hesitate to ease more if needed, emphasizing policy could change during the monetary review. Amazon takes the shine off big tech, warning revenue growth for its cloud business is slowing, sending European stocks and U.S. futures lower. Intel points to a strong second half. Plus, NatWest shares actually sink as the lack of an upgrade to its guidance offsets solid results at the bank.
We're clearly benefiting from the interest rate environment, but actually we're seeing good, strong loan growth as well across our business. The outlook remains a little bit uncertain. We're still in challenging macroeconomic times.
The focus fully on the data. We're just getting some GDP update, not only from Italy, but from Germany. Now, Italian preliminary first quarter GDP rising 0.5%. This is better than expected because we were expecting a 0.2% increase. For Germany, GDP is pretty much unchanged, and we were expecting a gain of 0.2%. So again, this is just the first quarter. It's preliminary, so things change as you, for example, account for some of the adjusted items. But for the moment, Germany disappoints, and Italy actually a little bit better than expected. Let's also look at the markets, and the focus on the markets is firmly on a lot of the earnings that we've seen coming through. I know NatWest putting a bit of pressure across the board for some of the banks, but also global stocks ceding some of the earlier gains, because earlier I think they were gaining by around 1%. Now they're either flatlining or getting some 0.3%, and there's more and more economic data showing resilience and persistent inflationary pressures, which seems to be cementing some of the focus on what central banks do, which is more interest rate hikes. So you can see that European stocks have turned a little bit. They were gaining, now pretty much flat. And then the dollar index, one we really need to look out for, 1,230. Now, the other big story is, of course, Amazon. This putting certainly a dampener on some of the better than expected earnings. If you look at what Meta did the day before, that was stellar results. Amazon, concerns about the clouds going forward, down 2% in pre-market. And so if you look at Intel, they came out with earnings that actually beat expectations. They're still one of the biggest gainers. But this move overall and questions about Amazon going forward could hurt a little bit of Wall Street when it opens in hours from now. Now, the Bank of Japan has announced a long-term policy review, with Governor Kazuo Ueda saying it will cover the year starting from 1998, around the time that deflation began. Ueda, speaking after his first meeting in charge, said the chance of normalization during the review, quote, is not zero. Let's get more now with Bloomberg's global economics and policy editor, Kathleen Hayes, in Tokyo. So Kathleen, thank you so much for joining us. What are the key takeaways from this press conference that was actually quite rich in news?
Well, certainly everyone was wondering, since Sankei News here in Tokyo reported over the weekend that the long-term, the policy review that had been discussed publicly, Kishida had talked about it, the Prime Minister, certainly Ueda had talked about it, that it would be a long-term review. Now we know it's going to be a year to 18 months, and we know that it's going to cover not just coronanomics or what happened recently, 25 years. It's going to go back to when Ueda was just starting at the BOJ back in 1998. So it is going to be long, it's going to be comprehensive, and many people immediately jumped to the conclusion, well, I guess that means we won't see any policy change before then. Or others said, what actually Ueda said today, it's so long, of course they're going to be able to make policy changes before then. But what have they signaled? For now, no change in short-term rates, no change in yield curve control. They dropped forward guidance that was put in place back in 2019 when COVID started, pledging a lot of stimulus as needed and making it clear that they would keep rates low or lower than they were as needed. They've dropped that, and now they're talking about being nimble and patient, trying to hit the target, 2% target, nimbly and aggressively, and he is still doubtful, the BOJ is still doubtful that they're going to make that anytime soon. So nothing did that different at the beginning of what Uedanomics may turn out to be.
Yeah. So Kathleen, no change at all in yield curve control. Why?
Because they're not sure inflation is going to stay above 2%. I'd say it's as simple as that, and they're not too worried about the bond market functioning, because look what's happened. Global bond yields seem to have capped. The Federal Reserve looks like it may be getting closer to the end of rate hikes in the beginning. 10-year JGBs have not been pounding at the top of that 0.5% top of the yield curve band. The yen is in a very comfortable range right now. So it's a time when they aren't being pressed on that point. And as former Deputy Governor Masasumi Wakatabi told me yesterday on Bloomberg Television, he recently left the BOJ, that the BOJ, they're not worried about being behind the curve on inflation. They want to be behind the curve. They made mistakes in the past. They tightened too soon. They didn't let inflation forces take hold and kill the deflationary forces entirely. And they want to make sure they don't do it again. And that's why we're not seeing any change, any indications of yield curve control change yet. But I would say Ueda knows that sometime in his reign, it's going to have to be changed and probably will be changed, but they're not on the doorstep yet.
Kathleen, thank you so much. Bloomberg's Global Economics and Policy Editor, Kathleen Hayes, in Tokyo for us. Now, joining us is Megan Brennan, Portfolio Manager at Saracen and Partners. Megan, thank you for joining us as well. There's a lot going on with the BOJ. I don't know whether it's symptomatic of, they're going against actually what every other central bank is doing. So is that problematic? How do you play that?
Look, I think this really highlights the conundrum of central banks at present. We've got extremely strong labor markets. US GDP is still pretty strong. Consumer spending is really robust because labor markets themselves are still strong. So we really are seeing, the first part of the inflation normalization was really driven by energy and supply chains. The second part of that is going to be much more difficult. So something that we're really concerned about is the impact on company earnings as the Fed and the BOE, the ECB, are forced to tighten further to kill consumer spending or to moderate consumer spending, and the impacts that has on the financial system. We had near misses in the UK with the LDI crisis, in the US with the regional banking crisis, and we're just investors, it really feels like, are waiting for what the next problem will be with the plumbing.
But so is there a concern that actually we're waiting about what could turn ugly, and so we actually don't look at the full picture? There does seem, I can't make up my mind whether there's a bias in the markets that things will be okay, or whether they think that something will be bad without really looking at the economic data that we're being given right now.
I think you're right to ask. It's a mixed picture. We are concerned about the $2 trillion of losses sat in the the US banking system since the interest rate hikes in the US. That's going to create an inherent fragility, which ultimately could be a cause for not a credit crisis, but certainly a moderation in credit availability, which should impact consumer confidence. I mean, since we've had the Silicon Valley Bank issue, credit conditions, particularly for small and medium enterprises in the US, have really tightened, and we saw that with results from big IT resellers in the US this week, and biotech as well.
So, Megan, again, what does that mean for the Fed? And is there a chance that they focus more on the credit crunch and tighten financial conditions instead of fighting inflation at this point? Are we going to see a Fed pivot?
Well, they have a dual mandate. I mean, our view is that they hike to 5.25 and then hold there for 2 quarters until they see the impact. But it seems really that the impact on the economy is disproportionate, and that it will impact, say, smaller businesses and life sciences and technology disproportionately to, well, smaller technology companies to, the larger companies. And we really haven't seen anything to drive a pivot just yet, but as we know, monetary policy operates with long and uncertain lags. So
what does that mean for dollar?
Probably eventually a weaker dollar, but who knows at this stage.
So is there a model that you look at? Because it does seem to change quite quickly, and it seems like the market could bifurcate almost at any moment.
Yeah, well, we're really focused on company earnings and the equity risk premium and earnings yield of the companies that we invest in. So that's our key driver of our risk attitude. I mean, we've been underweight equities for the last 2 quarters, just on fears that earnings would come under pressure, and earnings expectations moderated coming into this earnings season. So far, it's been pretty strong, but that's something that we're really focused on.
Megan, thank you so much for joining us today. Megan Brennan, their portfolio manager at Sarazen & Partners. Coming up, NatWest plunges despite posting a first quarter earnings beat. We'll hear exclusively from the Chief Executive Officer, Alison Rose. That's next, and this is Bloomberg.
brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, China and EU relations have been tested this week. That's after Beijing had to distance itself from comments about sovereignty of ex-Soviet nations made by the Chinese ambassador to France. Now, joining us now is François Chitung Wu, the Taiwanese representative to France. Thank you, Representative Wu, for joining us today. What do you think China's endgame is here?
I think we actually is facing on a big problem with China. China trying to use a very old concept to try to change the world order. So the declaration of Ambassador Liu Shaye just reflect in their deep in mind what they see the world. So it's making us in a very difficult problem, and without intention, they just also make the problem of Taiwan the same problem with other ex-Soviet Union country.
Representative, it's very clear that the French president's efforts during his recent visit to China have tried to make amends or at least get much closer to China. Do you think those efforts will pay off in trying to find a solution for Ukraine?
I think the question between Taiwan and Ukraine is, I cannot say totally different. In some way, we are the same problem. It's a big country, big old empire trying to enlarge their territory. But for Ukraine, of course, the problem when the Ukraine war happened is one of the reasons is that not so many countries believe that the war will happen. But for the Taiwanese question, I think Taiwan, Japan, USA, or all the country is preparing eventually aggressivity from China. So I think it's not a very similar problem. In some way, again, I just insist again, it's a problem that the old empire try to enlarge their territory. But now the preparation from Taiwan and from Ukraine is totally different. So if we can encourage the world to send more alert to China, that if China use an unilateral aggressivity to Taiwan, then the world will be concerned, then the pay will be maintained. And I think it is really, really very, very important.
Yeah, do you think it's possible that Taiwan at this point also considers buying weapons from France, or is the pressure on France from China too big?
But by definition, it is impossible to make a distance from France to Taiwan. Just for a very basic example, for example, Taiwan is a European country that is closer to Taiwan because of their New Caledonia territory. Another thing, by definition, again, Taiwan, what we are share with France, with Europe, with the world. For example, for our semiconductor production, for our trade with the world, it is impossible to separate Taiwan and the world. And more, I think also with the value that we represent, Taiwan is a very important symbol that Chinese-speaking society can live with a universal value. So with this representation, the world just cannot separate Taiwan with the world and with France.
Do you think, in terms of, I guess, economic ties, then leaving maybe some of the buying of the military to one side, that France and Taiwan can cooperate closer on semiconductors?
I don't know if the world knows that the semiconductor production itself is a production of cooperation between democratic countries. At the beginning, I mean, for the design, USA, Europe play a very important role. Then the Netherlands play the machine, ASML, for the production of the semiconductor. Then, of course, it is produced in Taiwan. Then we need air liquide from France. We need bus from Germany. We need chemical production from Japan for the precision of the production of semiconductors. So France already play a role for the production of these pills. So I do believe that we can reinforce in a lot of way our cooperation, not only between Taiwan and France, but as well as with Europe, with all the democratic countries. It is just by definition.
Of course, but are there incentives that France is rolling out to Taiwanese, for example, chip companies, maybe to also do something in France?
Yeah, of course. For the past months, past years, I received a lot of demand from the France senator, deputy, even the political side, or regional political politician that if there is some way that Taiwan can work with France. I think we are working on that, but I'm not sure if it will be realized. But I just can assure you that it is a very important thing for my job to try to put more cooperation in terms of semiconductor between France and Taiwan.
Thank you so much, François Xizhong Wu, the Taiwanese representative to France. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. New data shows U.S. economic growth is slowing and inflation accelerating even before the brunt of any credit crunch stemming from recent bank failures. GDP rose to an annualized 1.1% in the first quarter, notably less than the median forecast of 1.9%. Meanwhile, the Fed's preferred core gauge of prices picked up to 4.9%, highlighting the challenge of taming inflation. Now, House Speaker Kevin McCarthy stepped up his demands for President Joe Biden and the Democrats to avoid a debt ceiling crisis. McCarthy told Bloomberg TV they should embrace the plan that House Republicans passed, one that calls for cuts in federal spending. He said the Senate's done nothing and the president is ignoring the problem. In China, the Communist Party's Politburo said the country's economic recovery needs continued fiscal and monetary support. It also warned that domestic demand is insufficient. The Politburo is the top decision-making body led by President Xi Jinping. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thanks so much. Coming up, NatWest plunges despite posting a first quarter earnings beat. We'll hear exclusively from the Chief Executive Officer, Alison Rose, next. This is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
We're clearly benefiting from the interest rate environment, but actually we're seeing good, strong loan growth as well across our business. The outlook remains a little bit uncertain. We're still in challenging macroeconomic times with rising interest rates. We clearly benefit from those, but also inflation remains high, but starting to come down. So still pretty tough, I think, but we are seeing positive signs going forward. We've had good data from our recent PMI report showing business confidence coming back, low levels of impairments. Businesses and households are proving to be very resilient and performing well.
How would you describe the performance of UK or the behaviour of UK customers right now?
Yeah, we're seeing very low levels of distress and impairment. In our Q1 results, very low impairments there. We're not seeing distress from customers. We are seeing really rational behaviour. If I look at, spending data on our debit and credit cards, what we're seeing is customers are economising, making different choices about how they spend, managing their budgets really well. We've seen customers, more affluent customers, paying down more expensive debt, maybe prepaying mortgages. So there's a lot of resilience. And on the business side, again, very, very low levels of impairment.
Can I ask specifically how you see the outlook for the mortgage market? You talk about some people are paying down their mortgages, but obviously it's an extremely hard environment to remortgage at higher rates. So what's your outlook there?
Yeah, we're expecting the mortgage market to be a little flatter this year. We stayed in the mortgage market last year when there was that really period of disruption caused by the mini budget, and that's seen our mortgage growth be very strong in Q1. But, we are seeing house prices, predictions on house prices being affected, house values, lower mortgage demand, and it is expensive. But mortgage rates are coming down. If you look at where they were in the peak in Q3, Q4 last year, they are coming down, but we're expecting lower activity in the mortgage market.
That was Alison Rose, NatWest Group Chief Executive Officer, speaking exclusively to Bloomberg. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. London time in our half-an-hour country focus, Bloomberg UK. Coming up, BOJ Governor Kazuo Ueda keeps the door open to normalization. During its long-term policy review, we'll get the view from Nouriel Roubini. That's exclusive, and that's up next. And this is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Now the yen slides after the new BOJ governor's dovish debut. Kazuo Ueda says he will not hesitate to ease more if needed, emphasizing policy could actually change during a monetary review. Amazon takes the shine off big tech, warning revenue growth for its cloud business is slowing, sending European stocks and U.S. futures lower. Intel points to a stronger second half. Plus, NatWest shares sink as the lack of upgrade to its guidance offsets solid results at the lender.
We're clearly benefiting from the interest rate environment, but actually we're seeing good, strong loan growth as well across our business. You know, the outlook remains a little bit uncertain. We're still in challenging macroeconomic times.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Bank of Japan Governor Kazuo Ueda says there's a chance of shifting to policy normalization during its long-term policy review. Now, Ueda announced the review this morning after leading his first meeting in charge. Well, we are delighted today to be joined exclusively by Nouriel Roubini. He's Chairman and Chief Executive Officer of Roubini Macro Associates. Nouriel, as always, thank you so much for joining us. We'll talk a little bit about your new book as well. Congratulations on that. When you look at the BOJ, they always come out with some kind of surprise. A lot of the focus today, of course, is also on the new governor in charge. How do you interpret what the BOJ's big challenges will be in the next quarters?
Well, clearly the BOJ has to phase out first the YCC and widening the band on what is allowed for the long bond rate, but then they'll also to normalize the policy rate that right now is still negative. Traditionally, the BOJ, unlike the ECB and the Fed, wants to surprise markets rather than signaling to the markets what they want to do. And in this case, surprising market is important because otherwise, if people know there'll be a change in policy, they can go and try to push yields on the long-term bonds much higher before the decision is made. So I would expect that this year the YCC will be phased out gradually. When, we don't know, but it's going to happen next few months. And they'll have also to normalize the policy rates from negative to zero and then positive, given that inflation rate now is closer to their target, actually right now above their target.
Yeah. So, Nouriel, overall, is there a lot of volatility? Could something turn actually with the BOJ to you know, for it to be an unsavory event?
Well, we live in a world in which there is still economic uncertainties, both in terms of whether there'll be a hard landing for the global economy, what's going to happen to China, the situation of US and European banks. There are both a downside risk to economic growth and upside risk to inflation. The latest inflation numbers out of the US and Europe have been above what policymakers were expecting. Policymakers would like to do another rate hike in US and Europe and then stop and pause, but the economic data may not allow them to do that. So stuff can happen. And then normalization of policy rates by the BOJ is going to have also global effects. Rates were very low in Japan. A lot of money from Japan went into global markets, including fixed income in US and Europe. And if the BOJ were to normalize, the money is going to come back to Japan, and that could actually have impacts on long rates, especially for US Treasuries.
Nurullah, what's your take on the US? Is it actually heading into stagflation?
Well, inflation is still well above target. Core CPI was at 5.6, is falling, but not fast enough. The Fed has revised upward their prediction on what core PC is going to be by the end of the year from 3.2 to 3.5. They want to, in principle, hike in May and then stop. But if inflation were to become more persistent, that option is not going to be available. And then the Fed is going to be in a very serious dilemma, or in actually a trilemma. They want to achieve price stability, growth stability, and avoid a hard landing, and financial stability. If inflation is going to have core PCE a handle of 4% rather than 3% by the end of the year, then you'll be in trouble because you'll have to raise rates well above 5.25. If you don't do that, inflation expectation get de-anchored. But if instead you raise rates above that and markets are actually pressing in at cutting rates, so there'll be a surprise, then you could have one, a hard landing of the economy, and more financial instability for the banks and for overall long rates as well. So achieving price stability, growth stability, and financial stability with one policy tool, that is the Fed funds rates, to me looks like mission impossible. So either a hard landing and a financial crash, or the anchoring of inflation expectations.
So what you're telling me is that this is not going to end well, and it goes back to the idea of a doom loop, right, that you've been talking about for the last month. Are we getting closer to that, given the latest set of data and policy done by the Fed?
Yes, in the sense that right now there is a credit crunch. The regional banks will have to contract credit, and the regulators are going to tighten also their supervision regulation of banks, especially the regional banks. These regional banks are a significant source of credit to households, to SMEs, and to commercial real estate. People have already estimated that the impact of the current credit crunch on U.S. economic growth is going to be at least 50 basis points. The U.S. economy has slowed down already in the first quarter to 1%. If you go from even 1% to something like 50 basis points less, you are close to zero. It's a growth recession. And if that happens, the amount of distress in financial market will become more severe. We'll start to see rising defaults for households on their auto loans, on their credit cards, on some of the mortgages. You're going to see rising default rates among highly leveraged parts of the business sector. And that credit crunch becomes more severe, makes more likely a hard landing of the real economy. And if you have a hard landing of the real economy, NPLs and defaults going to rise. So you end up in a doom loop between economic instability and financial instability at a time where inflation is still.
But so, Nurullah, what does that mean? How do you play the market then in this kind of environment? If there's an impending doom loop that you believe and that you've explained the consequences basically from A to C and to D and E on that, what do you buy now and what do you sell on markets?
Well, the markets have rallied in the last few months on expectation that the Fed is going to cut rates in the second half of the year. A rally both in equity markets and a rally in the bond markets. So the correlation between bond and equity prices remained positive like last year. Last year, however, bond prices were falling and equity prices were falling at the same time. I think that these expectations of the market are going to be dashed, because if inflation is going to be higher than expected, if the Fed is to raise rates more, then you need a correction both of the equity markets, and with inflation higher than otherwise, and the Fed not cutting rates in the second half of the year, bond yields will have to be higher. So you're going to see the same kind of a balance bear in equity and bonds that you saw last year. And that's going to be a significant loss both for safe assets, that are supposed to be the defensive asset, and for risky assets. So I expect higher bond yields and lower equity prices for the rest of the year in a scenario in which inflation surprises on the upside and growth surprises the downside. So the markets are going to be surprised in a negative way.
Nouriel, are you expecting a lot more banking turmoil, or have we seen the worst? Is that it? It was interesting to see the Banque de France governor, Villeroy de Galhau, today saying that actually there's a problem also with the CDS market. He called it dysfunctional, and he's asked for that to be reformed because of the lack of liquidity in it.
Well, in the case of the United States, it's clear that the business model of many regional banks can the loans at much lower interest rates and lots of mortgages at much lower interest rates. So the mark-to-market value of even the loan book would be much lower. The deposit base is shrinking and is very narrow. A large fraction of the deposits were uninsured, and giving to deposit only 50 basis points when they can earn 5% on a safe money market they invest in short-term T-bill is not sustainable. So the deposit franchise value of the bank is shrinking at the same time. By this standard, a number of regional banks in the United States are insolvent. And that insolvency is going to lead first to a credit crunch. It's going to become more severe. And two, a number of these financial institutions will have to be essentially taken over by the FDIC or otherwise restructured. So I would say that what has happened with Silicon Valley Bank is not the exception, is a canary in the coal mine that some parts of the US banking system, especially the mid-sized regional banks, are in severe trouble. And that trouble is going to become more severe as the economy contracts and the number of non-performing loans in the economy is going to rise.
Nouriel, thank you. As always, Nouriel Roubini, Chairman and Chief Executive Officer of Roubini Macro Associates. Don't go anywhere because, Nouriel, we'll talk about China next. Plenty more to discuss. Now, coming up later today, also don't miss our exclusive conversation with the Canadian Prime Minister, Justin Trudeau. That's at 6 p.m. in London. This is Bloomberg.
We can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, still with us, Nouriel Roubini, Chairman, Chief Executive Officer of Roubini Macro Associates. And Nouriel, you were talking about a trilemma, basically, that could lead to some kind of financial crash. We also talked about the banks. Are we underestimating the deep shifts that we're seeing in geopolitics between, for example, China and the U.S. and what that means for dollar supremacy?
Well, we are in a geopolitical depression. You have a bunch of regional powers, China, Russia, North Korea, Iran, who are challenging the economic, monetary, financial, and also geopolitical order the US, Europe, and the West created after World War II. There's a Cold War between US and China. The Cold War is becoming colder. There's even risk that eventually there's a hot war over the issue of Taiwan. And all this geopolitical depression is leading to decoupling, to fragmentation of the global economy, to balkanization of global supply chains. Now we care about safe trade and secure trade rather than free trade. We're talking about friendshoring and reshoring rather than offshoring. And we're emphasizing, security and over economic efficiency. All that implies fragmentation, a reduction of global growth, and increasing cost of production that is stagflationary over time. Restriction to trade in goods, in services, in the movement of capital, FDI, labor, data technology, and information, and it's getting worse over time.
No.
And I see the US-Chinese relationship getting worse. I was recently in Beijing. The tone is quite hawkish towards the United States. They say those who want Cold War will be punished. And in the United States, the presidential cycle implies that both parties, Democrats and Republicans, they have to outdo themselves to be tough on China. So unfortunately, I fear that in spite of the speech by Janet Yellen, in spite of attempts by Blinken maybe to go back to China, the relations are going to get worse before they get any better.
But what does this mean, Nouriel? So if you look at fragmentation, and it was striking, for me to look at Janet Yellen talk about fragmentation, also hear from Christine Lagarde talk about fragmentation. So again, are we underestimating this decoupling between China and the rest of the world, and what that even means for monetary policy?
Yeah, this decoupling is ongoing, is going to get worse. As I pointed out, it reduces economic growth globally. It increases cost of production. So it's one of the forces that is stagflationary in the global economy. Decoupling, deglobalization, restriction to movements of capital, of migration, reshoring of manufacturing, friendshoring, and so on. And we saw what happened with the UK. After Brexit, the UK is much worse off than the Eurozone in terms of growth and inflation. Why? Because these trade restrictions are imposing costs on the economy in terms of both lower growth and higher inflation. Of course, during the Great Depression, the trade war led to a more severe economic contraction and a more severe depression. So this fragmentation is a serious problem because some of the growth in the global economy in the last few decades came from globalization, from trade, from movement of labor, of capital, from greater integration of the former Soviet Union, China, India, and other emerging markets in the global economy, from a peace dividend. All of these things that kept inflation low, that were positive aggregate supply shocks, are becoming now negative aggregate supply shocks that imply weaker economic growth. That's why the medium-term forecast of the IMF for global growth are really quite mediocre, barely 3%.
But Nouriel, I mean, investors don't know how to model it. It's really difficult if you're a market participant to understand what the end game of this is. Out of everything we've spoken about so far, what's the most difficult decision that actually an investor needs to make now in the markets?
Well, traditionally, investors have some variance of 60-40, 70-30 risk parity, but that assumes that the correlation between equity prices and bond prices is negative. Risk on, risk off, growth and recession. But when inflation is rising even more gradually, long bond yields are rising, and therefore the discount factor for equities is higher, and equities correct. And long duration assets like tech and growth stocks correct even more than traditional equities. But higher bond yield means a lower price for bonds. And last year, you lost more money on the safe assets, 10-year treasury, because yields going from 1 to 3.5 implied price falling by 20%, while the S&P fell only by 15%. So the defensive asset was not defensive anymore. And in a world inflation is going to be average higher than 2% and growth is going to be lower, that's a bad world for equities and a bad world for bonds. So what can you do? You have to go into short-term treasuries that adjust in yield without having the price impact of long duration fixed income. You have to go into TIPS and other types of inflation index bond. You want to go into gold because in a world in which there is de-dollarization, however, gradually, the Chinese and other allies of the US have to go into assets that cannot be seized by the United States and Europe. Gold bullion in their vault is one of them. And then you have to go into sustainable real estate and infrastructure. So you have to rethink completely your asset allocation for a world in which there is more inflation, lower growth, and more stagflation.
But Nouriel, when you look at Europe, it seems to have stabilized, certainly compared to some of the risks that the European economy faced 2-3 months ago. Is that wrong? Are we too complacent about what European companies will face?
Well, economic growth has turned out to be slightly better for the time being, and the latest number came out today are consistent, but those numbers also suggest that the inflation keeps on remaining in the Eurozone significantly higher than the 2% target of the ECB. Now, the ECB probably would like to increase the depo rate by another 50 basis points in May in the next meeting and stop, but with a depo rate at 3.5%, when inflation is still by some measure 5% plus, real rates are still too negative. And therefore, I think that the hopes of the ECB that you can essentially stop after another 25 basis points hike may be dashed. Inflation may remain more persistent than otherwise. You have very low unemployment rate. You have aging of population. You have restriction to migration. You have labor strife. All these things imply wage growth well in excess of inflation and productivity growth. And therefore, if then policy rates will have to be increased well above 3.5, then you're going to have an economic downturn in the Eurozone. You're going to have losses on bonds. You'll have losses on the assets of the banks. There is a number of European banks that are actually quite fragile. Some of them are smaller, some of them are mid-size. And if there is an economic downturn, there'll be a rise in NPL. So I don't think that being complacent in Europe, when you still have a nasty war with a brutal Russian invasion of Ukraine, and this war is going to get worse, and you have also a Middle East that is in trouble, Europe is in a bad mood as well. So there are significant short-term and mid-term challenges to the Eurozone, the European economy.
Thank you so much for joining us. We'll have, of course, more from Nouriel, I hope, in a couple of weeks to just keep us up to date with his thoughts on this doom loop. Nouriel Roubini, Chairman and Chief Executive Officer of Roubini Macro Associates. Coming up, Amazon jolts investors as executives reveal growth in the cloud unit is actually slowing. We'll have the details next, and this is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
This is Bloomberg.
Earnings season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results, impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market? Do we get answers to that today?
The bottom line speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacqua here in London. Now, shares of Amazon continues to drag right now in pre-market trade. Now, the e-commerce giant has warned that growth in its cloud computing business is continuing to cool. Also trading in the red, Snap, after the company reported its first ever decline in quarterly revenue. Well, let's go straight to Bloomberg's Berlin-based tech reporter, Aggie Cantrell. Aggie, good morning. So let's start with Amazon. What stood out there?
So the principal thing there, Francine, is this guidance that came after the earnings were released on the cloud growth. This guidance around cloud growth is a concern to investors because it's always been quite a crucial part of the business that's been able to weather other economic shocks. But this is really about the company trying to strike deals with customers in order to lock them into longer-term contracts. That was a big part of why they say that they're optimizing costs to make sure that those customers are with them long-term. But it does strike a different note than we heard from other big cloud providers like Google and Microsoft earlier this week. Microsoft saying that they had gained customers for their cloud business with the promise to integrate AI into it, and Google Cloud announcing its first ever profit in its 15-year history. But what Andy Jassy says is that still there is a lot of a way to go for cloud in the future. Still 90% of all IT spend is on-site. So there's a huge potential for cloud transformation in the long run, and AWS is definitely part of that.
What about Snap's new ad tools? I mean, that wasn't really well received, Aggie.
Yes, so as Snap has been saying that they're tweaking their design of their direct response ads. That is something that didn't seem to do so well for investors, and we're seeing that in Snap's trading this yesterday and this morning. But really as well, the big point to make here is it isn't really about Snap's own behavior, but also where people are spending their money, and they're going to the sure bets of Google and of Meta as opposed to a smaller platform like Snap.
Aggie, thanks so much. Aggie Cantrell there in Berlin with all of our tech news. Now, later today, we'll also be speaking to Intel Chief Executive Pat Gelsinger. Well, shares jumping in pre-market trade after the embattled chip maker promised a recovery in the second half. That conversation, 4:40 p.m. UK time. More Bloomberg Surveillance up next.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
People ask me all the time, what is the key to being a really good investor? And I tell them, it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
Tech is probably underloved.
Those sort of big, high-quality tech names do look like they're in something of a sweet spot, given the conditions that we're in.
The defensive areas, to include some of those tech names, have certainly had a bid, and they're getting expensive.
It's a tough environment, but it's always tough, right? The markets are never clear.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The latest economic figures for the Eurozone are just out. They could determine what ECB policymakers do when they meet next week. The Bank of Japan's new governor scraps guidance on future interest rate levels. He's also keeping main stimulus levels unchanged and announces a long-term review of policy. And Amazon jolts investors. The biggest seller of rented computer power and software services warns the cloud computing growth is starting to slow down. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Chrissy Gupta in New York. Matt Miller is off this morning. Chrissy, very nice to see you. And it seems we've got the macro themes, the BOJ, big movement in the dollar yen, and a lot to talk about there. We've also heard a lot from big tech. There's a lot going on this morning.
Yeah, on the macro front and on the micro front, but really culminating on the macro front. What's interesting is even though there is perhaps some positive news underneath the hood, on the surface level, on the benchmark level, you aren't necessarily seeing that. Take a look at futures right now. You are seeing a move about 0.5% lower when you look at futures trading here. How much of that is simply being a little bit risk off ahead of the long weekend, post the earnings kind of volatility that we've seen? Remember, major moves. We're going to dive into that throughout the show, so stay tuned. To me, I think what's interesting is in the bond market and currency market, because Anna, you just mentioned the BOJ story, but take a look at what the 2-year yield is doing. Really propping up against a key technical level, 4% there. It was sustainably higher for a couple of weeks, above 4%. Now starting to test that level yet again. What does that tell you about the bets on the rate tightening cycle? And of course, what that actually means for how quickly that R-word, recession, could come to the United States. That's where you're starting to see the bond market catch a little bit of a bid. 5 basis points lower on the 2-year yield. What's interesting is even as the yield moves lower, the dollar moves in the opposite direction. Anna, that is all thanks to the Japanese yen. You are seeing a little bit of weakness in the Japanese yen because look, this is not Kuroda's BOJ anymore. You have a new sheriff in town. UATA is the one who's saying, look, we are going to not change our actual stimulus moves, but we are going to consider doing that in the future. Nevertheless, enough of a shock for the markets to price in dollar yen at 135 of a handle. NYMEX crude as well, a quick check there, 73 handle there, down about 1%, Anna.
Let's get some breaking news then coming through, Chrissy. We just had Euro area first quarter GDP figures coming through, growing at 0.1% quarter on quarter. The estimate was growth of 0.2%. And this is interesting, Chrissy, because this number then is a little bit weaker than had been anticipated. And that sort of flies in the face of the overall trend that we've seen in the data coming through of late. Earlier on this morning, we heard from France, from Italy, from Spain. All of those showed growth in the first quarter. In some cases, we hadn't expected to see that. There was a little bit of an underperformance coming through in Germany, and maybe this Eurozone data just picking up on that German impulse, just emphasizing, I suppose, the role that Germany plays, the size of Germany in that data set. And so a little bit of weakness there. Now, what you're seeing here on the map, the red that we see here on the European equity map, is not as a result of any of that disappointment in that data specifically, because that data's just hit. And this market picture has existed for the last half hour or so. Considerable weakness in peripheral European markets, in particular in the banking sector, and not with a great deal of very obvious drivers for that weakness. So we see Spanish banks pretty weak. We see the banking sector down in Italy as well, and other parts of Europe also following with a little bit of weakness. This, despite the fact we opened pretty flat here in Europe, and we had some ground to make up in terms of positivity on Wall Street yesterday. So a curious picture perhaps for Europe this morning. In terms of the euro then, just checking in on where we are there, down by 0.4%, but we have seen that strength in the dollar. It's strong against the yen, and that's been the dominant flow over in FX markets overnight, and the euro really just the other side of that. NatWest Group down by 5.8%. The banking business here in the UK, they have beaten estimates and net interest margins really benefiting from higher interest rates, but they didn't upgrade their guidance, and that's enough for the stock to go a little bit lower this morning. Numis Core is a really big mover. It's not the hugest business in terms of its market cap. It's a boutique boutique investment banking business, here in the UK. Deutsche Bank, quite a surprise to investors, quite a surprise to shareholders. Deutsche Bank buying this business, so that stock up by 67% today. Mercedes-Benz Group down by 1.8%. We've been hearing from the CFO. The company confirming guidance at the upper end of the range, but the market is it's just not enough in this market, it seems, and that stock goes down by 1.8%. Now, back to the breaking news we had about the European growth story. Bloomberg's Maria today was on the road for us. She's in Stockholm. She's at a meeting of European finance ministers and central bank governors. Maria, your thoughts on what we've heard today? We've got a swathe of data from individual European countries, and then this overall picture, first quarter GDP coming through this morning.
Yes, Anna, and obviously Euro area finance ministers are gathering here. There is a Eurogroup meeting of finance ministers going on as we speak, and you mentioned that GDP data that just hit the wire on the Bloomberg terminal. There's a number, of course, that we knew finance ministers themselves were interested in finding out. We see that there was growth in the Euro area at the start of the year. That is for Q1. The economy grew 0.1%. And Anna, as you alluded to at the start of the show, this is slight, less than compared to the estimate that some were hoping to see 0.2% growth in Q1. But the flip side to this is that, remember, Anna, the narrative going into the winter was that this was the winter from hell, that the European economy was really going to suffer as a result of energy prices and potentially fall into a recession. So you could argue, yes, it's not fireworks growth, but nonetheless, the worst case scenario has been avoided. A lot of this obviously will feed into the debate going on at the ECB next week, where, of course, we know that the European Central Bank will debate just how much they have to hike rates.
And Maria, you've of course been speaking to the IMF as well. They're talking about tighter policy. Square that with the ECB. Is that a nod to the hawks over there?
Look, in many ways, it is, because what you could argue is that the IMF says there is still an economy that is somewhat resilient, but inflation, and if you look at the numbers today that we saw across the euro area and some of the biggest economies, inflation is still very much to the upside, and it's nowhere near that 2% target that the European Central Bank, this is an entire mandate that they have, would aim for. So yes, the IMF clear on their message. The ECB will have to hike more. Let's take a look at Alfred Kramer, who spoke to us yesterday here at Stockholm.
What is clear is that monetary policy needs to tighten, and monetary policy will need to stay tight for longer in order to bring down inflation. Why is that important? Because the worst thing you can do when you fight inflation is loosen too early or pause too early, because that will require a second attempt to tighten, and that will increase the costs of the disinflation effort.
And that was Alfred Kammer, who is the director of the Europe unit at the IMF, which again, it's convenient and handy when you look at where the debate is at in the euro area, which is obviously understood at this point that the ECB will probably hike again, but the debate is by how much. Should they continue an aggressive path or actually go for a smaller 25 basis points next Thursday? If you look at the words of the IMF, what they say is if you go too loose, perhaps before you get to that target, then it's going to be more painful because you're going to have to be more aggressive in the future. So go twice at it.
Bloomberg's Maria Tadeo breaking down the rate story over in Stockholm. We thank you as always. Let's go from Stockholm to Tokyo. The Bank of Japan scrapped its guidance on future interest rate levels at its first meeting under new Governor Kazuo Ueda. At the same time, it's keeping its main stimulus measures unchanged in pursuit of stronger inflation.
The Bank of Japan judged that under current economic conditions, premature tightening represents a greater risk for achieving the price target than the cost of a delayed move.
Paul Dobson, Bloomberg executive editor for Asian markets, joins us now for more. Paul, look, they're changing their policy stance. On the surface, that's a hawkish move. Why is the market taking this as dovish?
Yeah, good morning, Kritzy. I think I can give you kind of three different reasons for that. First of all, positioning going into the meeting. The market was very alert for the risk that the BOJ was going to do something of a rug pull here, you know, kind of either removing its cap on bond yields or maybe even suggesting that it was moving towards a hike at some point in the future. There wasn't anything as dramatic as that. And so, you know, the market's instant reaction then is a little bit of disappointment. So that spells weaker yen, that spells lower bond yields, and is supportive for the equities market as well. Then add into that, like you said, yes, the BOJ did make some sort of shifts. It removed some of its forward guidance, but it didn't take away completely that impression that it's still an accommodative policy that it's running right now. It's still saying that it's ready to do more easing if that's needed, and it's still pretty loose in terms of the policy settings already. And I think on top of that, there's a third element, which is that the BOJ said it's going to do a review of past policy and see how things have been going up till now. But it's in no rush to do that. It said that may take a year, 18 months. And the market's interpretation of that is the BOJ is in no hurry to go anywhere particularly fast. And so a little bit more disappointment, a little bit more of a weaker yen as a result.
Yeah, this announcement of the review is really fascinating, isn't it, Paul? Because on the one hand, and certainly initially, people were asking, well, does this stay the BOJ's hand? Does this mean they don't do anything for a year and a half? Well, no, obviously that's not the case. And then we got confirmation from Governor Ueda that this doesn't change their ability to respond with monetary policy. The review is a sort of a big look back over the past 25 years.
That's right. So he was pretty adamant in the press conference afterwards. You know, doing this review does not prevent us from adjusting our policy earlier on. You know, so that's something that I think that investors will have to bear in mind, no matter whether we see any instant move now. And on top of that, you know, kind of like the other things that people are going to have to bear in mind now is, yes, the Fed is likely to hike again one more time, maybe two more times, but we're getting towards the end of that Fed hiking cycle, which should, all things being equal, start to suck the dollar down and give that yen support again, give the yen some strength. So being too bearish on yen right now may not be the right way to go, given those factors. The BOJ, you know, having in its back pocket the option to move earlier than that review, and on the other hand, US rates are coming lower again over time from here.
A really interesting dynamic in the bond space and the FX space as the BOJ and the Fed essentially at odds with each other. Bloomberg's Paul Dobson, we thank you as always for walking us through the story. We go from Tokyo to Silicon Valley and specifically to tech earnings. Amazon warning that growth in its cloud computing business is continuing to cool, dashing hopes that the company's most profitable division was weathering a lackluster environment for tech spending. Amazon CFO spoke on the earnings call.
As expected, customers continue to evaluate ways to optimize their cloud spending in response to these tough economic conditions in the first quarter. And we are seeing these optimizations continue into the second quarter, with April revenue growth rates about 500 basis points lower than what we saw in Q1.
Joining us for more is Bloomberg tech reporter Aggie Cantrell. Look, Aggie, Amazon is a consumer discretionary stock at its core, and yet at the very end of the day, a lot of the business being driven by that tech spending, by that cloud spending. Break it down. How big of a deal is this?
Exactly. As you say, it is a consumer discretionary stock, But the cloud is part of that. It's about them accommodating those customers as well. And by doing so, what they're looking at now is essentially providing discounts to those customers so that they can lock them into longer contracts. And that's about maintaining their market share, because for Amazon, AWS is really a long play. As Andy Jassy put it himself on that call, that essentially 90% or over 90% of all IT spend in the world is still on site. So there's still huge potential for the cloud transformation, which Amazon definitely wants to be part of. But you also see companies like Microsoft integrating AI into their cloud, and also Google Cloud this quarter said that they turned a profit for the first time in Google Cloud's 15-year history. So really, AWS is making sure that, yes, this might bite in the short term, but in the long term, they want to lock in those customers for those long-term contracts.
Yeah, Aggie, good morning. We also heard from Intel, didn't we? And whilst Amazon tells us something maybe about businesses' willingness to spend, or adds to our understanding there, Intel also tells us something about that, and consumers more broadly about their willingness to spend. The chip maker saying that it sees green shoots of recovery.
Yes, so it sounded pretty bullish on the guidance for the second half of 2023, especially when it comes to their gross margin, which is a key indicator for Intel. And so something that was also worth pointing out there is that in the first quarter, we all saw those numbers, 29% drop in PC purchases in the first quarter this year. And so that's a concern for a company like Intel, of course. But going forward, they see that this is going to be recovering, and they're expecting gross margins to also recover in the end of 2023.
Bloomberg's Aggie Cantrell, we thank you as always. Two crucial tech stories, and of course, stay tuned for an interview with the Intel CEO, Patrick Gelsinger, that coming up at 11:40 a.m. in New York, 4:40 p.m. in London. I want to broaden it out, though. Stick with the tech story because, of course, we are seeing a lot more movement in the pre-market as well. When you look at Pinterest shares, for example, down about 14% in the pre-market. Look, their revenue beat expectations, but the problem here is that they're talking about restructuring costs and a wider than expected net loss as well. This is a really big deal when you're talking about the macroeconomic environment kind of souring. Social media companies like Pinterest, even like Alphabet, are going to be the first ones to show that sign of distress before it kind of trickles into a lot of the value space. Nevertheless, 14% here as Pinterest really reevaluates their business model as well. Snap kind of in the same boat as well. They talked about their first ever decline in quarterly revenue, changes to their ad programming as well. Snap shares down 18%. The volatility here is enormous. The moves of somewhere between 10 to 20%, and a lot of these tech stocks, that's what's moving it on the benchmark level and on the micro level as well. Cloudflare as well is one we want to keep an eye on. It's set for its biggest ever drop after issuing weaker than expected revenue forecast, and on top of that, the cherry on top of a pretty bad Sunday, lowering their full year outlook as well, down 25%. It's that guidance that you, Anna, that you can really see the stock market already punishing Cloudflare for.
Yeah, absolutely. Quite a big move there. Now, coming up on the program then, Chrissy, we'll talk to Maria Staley, who is a Senior Portfolio Manager at Fish Asset Management. And we've heard from the BOJ, of course. That's big news today. Big news if we do end up seeing the end of yield curve control. We'll ask about the impact that that would have on markets. And the House Speaker, Kevin McCarthy, escalates his demands for Democrats to avoid a debt ceiling crisis. He spoke on Bloomberg's Balance of Power.
We're coming up on a debt limit here in June or July. That's where the default raises. So what the House did was the action to deal with the debt limit. The president has ignored this problem. He's actually putting the economy of America in jeopardy by not doing anything.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. everything you learn is additive every day. And if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping. Look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Bloomberg Surveillance Early Edition. I'm Preeti Gupta in New York with Anna Edwards in London. Matt Miller is off this morning. Take a look at this terminal chart here. For our radio audience, stick with me, because one of the big themes right now is not necessarily the macro. The Federal Reserve will be in focus next week. Right now, it's all about the earnings picture. What's interesting, though, is on the surface, you're seeing a lot of corporate America beat on their earnings, and that's a good sign. But when you actually look at the sales, the top-line growth, that's where you're seeing a little bit of a deceleration. And it's interesting because that's the same deceleration the economic data has been showing as well. That's exactly what this chart shows us. Again, our radio audience, stick with us. This purple line here essentially shows the PE ratio for the S&P 500, essentially trading on that earnings story, taking into account the valuations and the changes you're getting in these quarterly reports. The white line here shows the economic surprise index, and you can see they kind of move hand in hand. What's important to keep in mind, though, is that no longer does the S&P 500 hold a premium to the economic data, which means that the valuations have come down significantly. Does that create a buying opportunity as we start to see the economic slowdown really show up in some of these corporate earnings? Let's ask a true expert. Joining us now from Paris, which I'm told lives up to the hype, is Phil Serafino, Bloomberg Senior Markets Editor. Phil, two questions. One, do you agree that it lives up to the hype? And two, do you think that this kind of drop in valuation is justified when you look at the S&P 500?
Yes, Paris absolutely lives up to the hype, and I think the market really is reflecting what you were describing. There has been a big ratcheting down of expectations for the economy. Just this morning in Europe, we got numbers that show Europe is just dodging a recession. And so, you know, a lot of the exuberance has come out of stock prices, and that's a very good thing. You know, for all that, the S&P is still up almost 8% for the year. You know, if it keeps going at that pace, you're having a 28% gain for the year, which would be really outstanding. So the exuberance that we saw in 2020, 21 has come out of the market with the big sell-off last year. Now the earnings are coming through okay, not great, but that may be enough.
Yeah, earnings coming through okay. We see real weakness in some parts of the European stock space today, Phil, in particular around peripheral banking, around the Spanish market, around the Italian market. But you've pointed out to us before that stocks really can climb a wall of worry. I wonder if we're seeing some of that, or we will do when we get back to the green.
Absolutely. I mean, in Europe, the market's going to be down this week, but it's the first time in, I think, a month that the market has had a weekly decline. So, you know, it is holding up very well. There's been a constant drumbeat of concern about recession, earnings decline, and yet the market keeps grinding higher. It is that old cliche, the wall of worry. People are pricing in the bad news and then looking ahead to seeing a recovery in the future.
Phil, thanks very much. Bloomberg's Phil Serafino joining us there from Paris. And for more market analysis, check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal to find the blog. This is Bloomberg.
is covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
We're clearly benefiting from the interest rate environment, but actually we're seeing good, strong loan growth as well across our business. The outlook remains a little bit uncertain. We're still in challenging macroeconomic times.
The NatWest CEO Alison Rose speaking earlier to us on Bloomberg Television and on Bloomberg Radio. Shares of the UK lender are dropping after a net interest income miss and softer guidance on deposit growth offset a profit beat. And what's really interesting, Christy, she was talking there about how they've benefited from higher interest rates. We know that story very well when it comes to the banking sector. There's another story we've become quite accustomed to, is that's the resilience of consumers. And she's got a lot of data on that, of course. NatWest has that data. And she was telling me that they've seen a low level of impairments. People and businesses are paying down debt. It's a sort of stubbornly resilient consumer.
Yeah, it's interesting. And then also you have the other side of the equation, which comes down to that net interest income. This is a bank story at its core. If you are looking at rate hikes or the rate tightening cycle turning, is that bank stock going to be attractive? But then on the other hand, that net interest income isn't really working in their favor anyway, Anna.
Right, we will talk about markets. We'll get back to the BOJ, some of the macro themes of the morning. We'll talk to Maria Stelli, who's Senior Portfolio Manager at Fish Asset Management. That conversation coming up shortly. This is Bloomberg.
So you've built a successful company, might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The latest economic figures for the Eurozone are out. They could weigh into the conversation about what the ECB does with policy when it meets next week. Broadly, we got GDP data that came in below estimates. The Bank of Japan's new governor scraps guidance on future interest rate levels. He's also keeping main stimulus levels unchanged and announces a long-term review of policy. And Amazon jolts investors. The biggest seller of rented computer power and software services warns the cloud computing growth is starting to slow down. I'm Anna Edwards in London with Chrissy Gupta in New York. Matt Miller is off this morning. A lot of competing dynamics here then, Chrissy. We've got the BOJ news flow from overnight, the dovishness of that. So if you are waiting for a big bang, big change from the BOJ, it certainly wasn't this time around. We've also got the growth dynamics here in Europe. It seems to be the disappointment that's sticking there, so we can come to that in our conversations. And you've got tech news, of course, over in the US.
Yeah, a lot for investors around the world to digest. It's kind of like a story of traveling the world in 10 minutes, if you will. But risk sentiment is really souring in the States, which is interesting, given that the earnings picture is actually getting better. And this is something we're going to digest in just a moment. The S&P futures down about 0.4%. Does that turn around as we get closer to the opening bells and really see Amazon in particular drive the market higher? That's going to be a question for about 4 hours' time. We're looking at the two-year yield as well at about 4.02, testing that technical level of 4% on the front end of the curve. This is significant because, remember, in the last Fed meeting you did, and off the banking terminal, you saw the two-year yield drops below 4%. The question is it going to stay sustainably above it if you're still talking about the Fed ending its rate tightening cycle as soon as May, and then really not restarting it, if it even has to restart it, as late as even next year. So that's going to be something to talk about. As you see the move lower in yields by about 4 basis points on the front end, the dollar going in the opposite direction. And that's really a function, Anna, of this weakness you are seeing in the Japanese yen. This is not Kuroda's BOJ anymore. This is Ueda's BOJ, where he is saying, look, we're not going to change anything when it comes to what we're actually doing, but we are open to perhaps changing our policy stance. But then the market's saying, look, this is dovish because that could take a very long time to actually materialize. Nevertheless, dollar yen trading at a 135 handle and NYMEX crude trading at a 74 handle, which is interesting because we're getting closer and closer to 70 when you look at the American oil benchmark, that trading lower by about 0.3%. That's the macro picture. Anna, let's talk about the micro, because Amazon, again, is going to be the game changer for today's session. Executives saying that cloud sales growth this quarter is slowing after beating earnings in the previous period. That's a really big deal when it comes to these shares, down about 1.7%. On top of that, the e-commerce piece of the equation also buying less expensive items. So that's going to be really important when we talk about whether Amazon can actually grow as quickly as some of its other big tech peers like Microsoft, Alphabet. But if you're talking about an economic slowdown, social media companies are the first ones to get hit. Alphabet is a great example of that, but so are Pinterest, so are Snapchat, and that is exactly what you are seeing. Pinterest revenue beating expectations, but the problem here is they're talking about restructuring costs and a wider than expected net loss. Those costs mounting and really offsetting any sort of profit that they're making. Shares down about 14% in the pre-market, and Snap as well, seeing its first ever decline in quarterly revenue. They're changing a little bit of their ad programming. Those shares down 18%. A lot of rewiring, Anna, when it comes to the big tech space in the U.S.
It does feel like a day where investors are seeking out the bad news and finding the negativity and lingering on it. Maybe that's what we're seeing on various levels today, Chrissy. Perhaps that's what's dominating European flow today. We've got European stocks down by 0.3%. We've got the euro down by 0.3% against the US dollar. Perhaps the FX story is more about the yen today. We've seen, of course, real yen weakness against the dollar. That's pushed the dollar higher more broadly. So leaving that one aside, what is it that's weighing on sentiment today? Well, we've certainly got the news out of the tech space. But here in Europe, we've got the growth numbers. And I was just exchanging messages with some of our team here at Bloomberg News in London and talking about what it is that weighs here. Well, the German number, of course, was a disappointment. And that seems to be weighing on some of the more peripheral banking names. So we've got the, or perhaps that's at least adding to the negative sentiment around them. So we've got some of the banking names in Spain and Italy under pressure today. And the growth picture is front of mind for investors. NatWest Group is down by 5.8%. So a bit of weakness there as well, despite the fact that this is a business that beat estimates, but they didn't upgrade their guidance. And so the market is punishing that stock today. Mercedes-Benz, another company that confirmed the upper end of their guidance, but that one also down by 1.2% then, Chrissy.
Yeah, it's interesting. I think you're 100% right on the take that it is a little bit of a rain cloud on everyone's market trade today around the world, from Europe to the U.S. as well. Let's see if it's justified. Joining us now, Maria Shelley, Senior Portfolio Manager over at Fish Asset Management. Maria, is it justified? Let's start there.
Hi, good morning. To be honest, I couldn't hear your first question right now just because of technical problems. Would you mind?
Of course, no worries. Look, we're seeing a lot of red on the screen, Maria. We are talking a lot about kind of sell-offs in Europe as we start to see weaker banking numbers, also weaker earnings numbers there, but also weaker earnings stateside as well. A lot of the tech earnings not coming in as in the green as we saw earlier in the week. So it feels like it's weighing on global sentiment. Is that your take as well?
Yeah, so look, I mean, I think you're absolutely nailing it there. The market currently is quite guarded. We are in a rather boring period, and it's like feeling relatively good after the volatility we had in the first quarter to have a boring month. But be careful what you wish for, because I think things are going to get worse before they get better here. We are in this sort of consolidation phase. A lot of investors have the negative sort of risks top of mind. Positioning is relatively balanced right now. People have been buying stuff, but market breadth is relatively narrow. You can see also that, volatility has been coming down massively, but the volatility of volatility is still relatively elevated. So people are guarded. They are waiting for the next catalyst. And I think the next catalyst is going to come with the data that we are seeing currently coming out, still stubbornly high inflation, growth that is still, it's coming down, but it's still strong enough. The labor market's still strong enough. The central banks currently have the carte blanche to go on tightening.
Okay. Good morning to you, Maria. And with that in mind, where do you see the Fed heading? Or should I maybe say, how quickly do you see the Fed changing or heading in whichever direction? Because there doesn't seem to necessarily be a disagreement about which way the Fed heads, but just around the timing. We spoke to a guest yesterday who said the US economy is slowing really fast, and that's why she sees room for cuts towards the end of the year. Others, and you might be amongst those, think that actually we're not going to get Fed rate cuts this year. What's your thinking?
Yeah, I think the Fed is currently going on. I think 100% will see another hike. I don't think that the Fed is actually going to cut from September onwards. What the market currently is pricing for the Fed is what I think the Fed should do at the time, but not what the Fed will do at the time. Because the data that the Fed is looking at is mostly coincident and lagging. It's not the stuff that the market is actually looking at and telling, Fed, you probably should slow it down at some point, maybe cut a little bit, but the Fed is probably not going to agree with that because, they have to defend a decade of QE as a policy tool in order to have the tool available in the next crisis. So they want to make sure absolutely that they can bring inflation under control, and they are only going to stop doing that when they are pretty sure that that tightening was successful.
Maria, as a global investor, or by which I mean not in Japan, I wonder what you make of the Bank of Japan right now, because we heard from them overnight, of course, and there seem to be some people who are positioned for something a little different. So we've seen a move of 1.5% weaker in the yen as a result. Some are saying that yield curve control, getting rid of it, it's just delayed. It will happen, but it'll happen later on this year, and that could have global implications. What are you watching there?
Yeah, I think investors were pretty relieved not to see a massive turnaround today in the policy and in the communication. I think people may have missed a little bit that this is really giving them the optionality. It's buying them time to review the policy in more detail. I think we can be a little bit relieved that it's not today and tomorrow, but down the road. Bank of Japan is super important for global markets. Japan has a massive asset pool that drives the global market, so everyone invested in U.S. fixed income needs to follow the Bank of Japan as well. And I think once they are going to change their assessment of their policy, that's really when you need to also take a hard look at your U.S. Fixed income portfolio. But for the time being, relief.
Well, Maria, the Japanese also seen largely as a creditor nation. Connect the dots for us when you look at what the lack of movement, per se, for the BOJ. How does that translate to, say, the German bond market or even U.S. Treasuries? What kind of moves are we looking at here?
Yeah, for the time being, as said before, I don't think that there is a big impact right now. I think it would have been a shocker if also there was something really big to change at the first meeting of UEDA. For the time being, I think it's okay to be invested in fixed income markets in Europe and in the US. I think one really important detail that investors need to consider is that stealthy change in correlations that we have seen during the volatility in March. And I think, for the time being, correlations are still relatively high, and they are supposed to be high also during times when central banks are driving markets. But we have seen during volatile phases, correlations are changing. So, for example, the rates and spread correlation, or the correlation between equity and fixed income, has become very negative for a short period of time. That's something that I think will repeat much stronger during the last phase of the cycle. That's when you need duration in your portfolio again. It's going to work again as a safe haven asset. Yeah. And a lot of investors are underinvested in that portion of their portfolio. So I think that's something that people can do right now during this sort of boring phase. You can reassess your allocation. You can take really a good look at your overall asset allocation.
All right, Maria, 30 seconds. We're going to put you on the spot here. What do we see from the Federal Reserve next week? Is the 25 basis point market consensus exactly what we're going to see? And does that then mean that is the end of this rate tightening cycle, or do we see more hikes over the summer? 30 seconds.
I think we're going to see 25 basis points. Depending on the sentiment, they can actually go a little hawkish in their messaging. I don't think that they're going to guide towards cuts anytime soon.
Yeah, they keep protesting against the market's assumptions around those cuts, don't they? Maria, thank you very much for joining us. Good to get your perspective. Maria Stelli of Fish Asset Management, thank you for giving us your time. Coming up on the program, Amazon warns of a slowdown in the cloud business. More on what that means for the tech sector next. This is Big Red.
big idea is we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York this Friday. Matt Miller is off this morning. Now let's get to the tech sector. Amazon jolted investors with talk of a slowdown in cloud computing growth. The company's most profitable division saw a 16% gain in revenue in the first quarter. That's the slowest growth rate since Amazon began breaking out the unit's sales. Joining us now, Bloomberg Intelligence analyst Matt Bloxham. Matt, the focus really was on this cloud story, wasn't it? Because actually the market's reaction to the initial results was really quite positive, but all of that was unwound by this cloud news.
Yeah.
What does this mean?
Yeah, exactly. So as you said there, they posted 16% growth. The market's looking for 13 or 14. So at first it looked like it was a good print, but then they indicated that April growth was about 5 percentage points slower than that. So suddenly people, oh my goodness, there's a big slowdown here. They're losing market share. Spending by corporates is slowing down. But it did contrast quite a lot with what Andy Jassy, the CEO, tried to get across on the call, which is there's still a huge runway of growth for cloud, and they're a very strong player, the strongest player in that marketplace. He said 90% of IT spending globally is still on-premise, so in corporates buildings, and that's over time going to flip to cloud. So there's a huge opportunity there. And in the short term, they're saying, look, our clients need to optimize their spending. We're happy to take a short-term revenue hit to build strong long-term relationships with clients so that we get a big share of that growth.
So at that 90% figure, I suppose that just illustrates the big opportunity that is still there, but I guess also underscores the growth rates that could be achieved. I mean, 16% sounds good, but it's not what we are used to from that part of Amazon's business.
No, it isn't. It's been in the kind of 20% plus growth. If you look at their rivals, Microsoft and Google, they're smaller businesses. They're growing in the kind of 25 to 30% range. And our consensus has for all of those businesses, if you look at the Bloomberg MODL function, a slowdown in growth in Q2 and beyond. So for everybody, they're expecting that you can't just keep that growth rate going forever. But I think it was that kind of that sudden shock in the commentary that, growth has really slowed in Q2 that really made people reevaluate their first take of the results.
So Matt, what is the bigger red flag here? Is it the slowdown in cloud services, which, to be fair, only makes about 17% of their revenue? Or is it, at the end of the day, the slowdown in consumer spending? What's the bigger risk?
I think the cloud is the bigger risk because although it's only such a small part of their revenue, it's actually over 100% of their operating income. So it's hugely important to profit and cash flow for Amazon. I think whilst there's some pressure on consumer spending, the online business was growing pretty well. Their advertising business, which is leveraging AI, is growing pretty well too. And I think if you look into the second half and beyond, a lot of the efforts they've taken, the headcount reduction, the restructuring of their online logistics should boost the profitability of the online sales business in the second half. So probably momentum looking better, but really the cloud business is where all of the profit is and where all the growth is likely to come from going forward.
I love that you mentioned the layoff story because it's so important when you talk about the margins for the tech sector broadly. You mentioned logistics as well. For me, when I think Amazon, of course, we know that they are trying to build their presence in the cloud sector, but the e-commerce sector still requires some of that efficiency that you just pointed out. How long till they get there?
Well, I think that they're hoping for the kind of those kind of cost reduction efforts to start to show some evidence in the profit numbers in the second half of the year. So I guess that's what people are looking for. You know, it's a really big shift in the US where they've gone from a national model to a regional logistics model, which is reducing costs for them and improving the speed with which people get their goods. So it's kind of a win-win for them and their customers. And I think they sounded very confident yesterday that that's going to start to really give some benefits as we go through the rest of this year.
And you mentioned AI, Matt.
Yes.
We can't go through an earnings report without mentioning it.
Yep.
I'm sure it was, ticked off your list of companies mentioning AI yesterday. What do they have to say?
Well, it's quite similar actually to Meta that, they're saying we've been doing AI for, I think they said over 25 years. They described it actually as machine learning, which is kind of the same thing. And it's really in the current time helping their advertising business, which, is a challenger to the likes of Google. And they're saying using machine learning and AI, we're able to optimize brands with what consumers are looking for. So consumers are getting the product they want. Brands are seeing the investment in advertising on their platform is giving them big returns. So it's, again, a win-win, and that's what Amazon's all about.
Okay, Matt, thanks very much. Matt Bloxham of Bloomberg Intelligence, thanks for bringing us the Amazon story and all the other tech stories you brought us earlier on this week. We appreciate your time. Up next, we'll get the latest on politics. McCarthy puts the pressure on President Biden for a debt ceiling resolution. Part of our interview with the House Speaker next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Matt Miller is off this morning. House Speaker Kevin McCarthy is stepping up pressure on President Biden and the White House to avoid a debt ceiling crisis, just as the administration delays negotiations. McCarthy spoke on Bloomberg's Balance of Power last night.
It was 85 days ago I sat down with the president, February 1st, talking about finding a sensible, responsible way to raise the debt limit and make us less dependent on China, curb inflation, and bring growth to this economy. And that's exactly what we just did. The president then said he wasn't going to meet with me until we showed him a plan. So then I showed him a plan, and then we passed it. You know, the way government works is the House passes the bill, the Senate passes a bill, and then you conference together and the president can decide whether he signs it or not. The challenge here is the Senate's done nothing. But I shouldn't be rude. They did name March Maine Maple Syrup Month. They did get that done. But they haven't done anything on the debt ceiling, and the president has ignored this problem. He's actually putting the economy of America in jeopardy by not doing anything, because only the House has raised the debt limit, passed a bill to do that, and at the same time grow the economy. And we did it with ideas that he has voted for, work requirements. He voted for that as a senator, but more importantly, just a couple months ago in Wisconsin, it passed with 82% of the vote to limit our growth in the future so government doesn't get out of control. Well, that's an idea from Joe Manchin. We help the supply chain. We repeal 87,000 IRS agents. We make America energy independent. We cut the red tape so we could build things again in America. I don't think that's radical. And the words that are coming out of the White House that we are going to melt children's bones, we're going to create asthma, there's nothing in the bill that does that. It actually protects veterans, protects our military, makes us curb inflation, but keeps us at a stronger pace for the future.
House Speaker Kevin McCarthy speaking to Bloomberg's Anne-Marie Hordern. Now let's get a look at what is ahead on the trading diary, the trading calendar for the day. Before the U.S. market open, we'll get earnings from Exxon and from Chevron. U.S. eco data today in focus. That includes the core PCE deflator number. That's the Fed's preferred inflation gauge, of course. We also get the Chicago PMI and the University of Michigan consumer sentiment reading. And don't miss David Weston's exclusive interview with Canada's Prime Minister Justin Trudeau on Bloomberg TV at 1 p.m. Eastern Time. I'll pick out of that lot then the earnings we get from big oil. That'll be interesting then, Critty, because next week we'll hear more from the European side. We've had a lot of focus on banks on both sides of the Atlantic, haven't we, in terms of the earnings stories last week and this week. Next week we'll pivot to oil here in Europe, so that's going to be a big focus. But in terms of the data, really interesting to watch the PCE numbers. Now, we are expecting the headline figure to drop down from 5% to 4.1%, but core remains stubborn, 4.6%. It's expected to stay exactly there, and that won't really aid our understanding of where the Fed goes next, I suppose, if we're not seeing much movement on that core figure.
Yeah, I mean, the story is one and the same. At the core, it's inflation at the end of the day. I want to start with the earnings piece that you just brought up, Anna, because at the end of the day, Chevron and Exxon have posted 2-3 quarters of record profit for oil companies, also really opening the doors to things like capital markets, debt issuance, equity issuance, things like that. But that only lasts as long as oil prices are higher. In the same vein, core even matters extra because you are starting to see that tick up in the core numbers from the CPI. So the PCE deflator will really give the Federal Reserve some indication of whether those core number kind of tick up was really something to panic about, which the market did, or if this is something that was kind of a one-off and you are still seeing that deceleration.
And ahead of that PCE data and other consumer takes in the United States, we're of course getting data out of Europe, and we've had a lot of that. We look ahead to German inflation data, that's still due out. We've seen an uptick in some of the inflation prints we've got out from the Eurozone, Critty, from France and from other places here in Europe. So that's a little bit of a worrying sign when it comes to that inflation dynamic. And on the growth side, perhaps worrying that we've seen the number come in lower than was expected in certain parts of Europe, in Germany in particular, and for the overall Eurozone.
And I think when you mention that inflation tick up, it's not just a European story, although Spain is also part of that narrative. You're seeing it in Brazil, Indonesia. It is going global.
Absolutely right. Early edition, that is it for Surveillance Early Edition. We will get to Tom, John and Lisa for Surveillance shortly. They'll be hearing from a host of voices about these markets. They'll get you set up for the data ahead. This is Bloomberg.
wrong, and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional assets monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, oh, the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
People talking about a slowdown in the economy, except the S&P sits at 4,100.
I do think that there is a danger that tech can't continue to do the heavy lifting for the entire market here.
Broadly speaking, businesses are anticipating a slowdown in the economy.
All those lead indicators pointing to slowdown/mild recession. I don't see how we escape it.
I really do think that the data are going to have the Fed hiking further.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P 500 negative, 1/3%. Big turnaround after the close yesterday in Amazon, initially rallying hard, then rolling over. Some soft guidance around the cloud. We'll discuss that in just a moment. Tom, we need to wrap up the week and push ahead to the Federal Reserve and payrolls next week. Big week just around the corner.
Big week around the corner, and I'd center on May 3rd, yes, but I'm going to center on the Monday. Monday is May 1, and the heart of the matter is, and you know this, folks, sell in May and go away, and a lot of people publishing now about next week. You're right, May 3rd onto Apple May 4th, and dare I say the full moon on May 5th. There's a lot to analyze here coming into next week.
And the ECB somewhere in between as well. I don't know what happened to the month of April. What happened to the month of April?
It was cold.
Gone. Bang,
cold.
Just
For
like
those
that.
of you here, I know there's heat wave in Spain and in Italy.
It was cold.
AC Milan?
What about it?
I mean, I think in May. I mean, that would be a good place to be.
I can tell you that that's happening.
That's
Tickets
good.
secured.
That's good. We were going to do the tops.
Funding not quite secured.
Working on the
but
rounds.
tickets secured.
But the point here is the weather here has been chilly, and like Amazon yesterday, there was a chill put on the verbiage of 4 p.m.
It was not one. The numbers came out, Lisa. The stock initially really rallied quite hard by, I think, more than 10%, then rolled over. Soft guidance around the cloud. The story of the week, though, hits and misses in tech across the board. Microsoft great, Meta great, Google kind of meh, somewhere in between. What's Amazon?
Amazon, with respect to the numbers, great. With respect to the guidance, concerning, maybe. I mean, this to me really tells you a lot when you've got a 14 percentage point swing in the stock price after reporting earnings going up 12% and now at one point down more than 2%. How much do we really glean from the sentiment? Basically how whipsawed people are from the uncertainty of what's going to drive growth going forward. Is it cloud or is it potentially greater margins and consumer sentiment?
We're addicted to a big double-digit cloud growth. And Ana Aguirre, who's arguably best in the world on this at Bloomberg Intelligence, makes clear, yes, you're going to see an ebbing
of the cloud short term. That's how you get, Lisa, to your 14% swing on Amazon. But where is cloud in 2024?
Well, and it goes to this larger story we were talking about yesterday, John, which was that essentially businesses aren't spending as much. And we saw that in the Q1 GDP. There's a real retrenchment in business spending, including on technology, including on cloud infrastructure. So is this an Amazon issue? Because we didn't see the same kind of issue with the Azure platform for Microsoft. Or is this something broader about business spending?
Well, the broader question, I think, going into Q2, and we are in Q2, how much momentum do we have in this economy? I was going through the Southside research on economics yesterday. Overwhelmingly, this is the consensus right now. Bank of America expect the momentum in the economy to continue to slow in 2Q. BNP Paribas, we continue to anticipate a recession in the second half of 2023. Morgan Stanley expect to see significant slowing in 2Q 23. TK, that's the consensus right now amongst economists on Wall Street.
And I would say, let me get it up here to get the dates right, John. I don't want to mislead people. We wouldn't want to do that on a Friday. FOMC Go yesterday shifted from a May 3rd meeting, where I think we've got a pretty good grasp of what's going on, to a complete debate and mystery over June 14th and then on through the summer. I think it's fascinating. I think yesterday we saw that shift.
Do you want the other side of the debate? Citi's Andrew Hollenhorst says this. After hiking 25 basis points next week, Fed officials will likely be revising up growth and core inflation forecasts in June. So that's the split right now. You've got pretty much everyone on one side, somewhere in between, and then Andrew Hollenhorst saying, you know what, nothing's changed here. Fed's going to have to keep on hiking. They're going to be revising their forecasts higher when they meet in June. Let's get to May 1st. Pushing through April, your equity market negative 1/3% on the S&P 500. Just a little bit softer here. In the bond market, yields coming back in by 4 or 5 basis points. Your 10-year there, Tom, 3.47% on a 10-year.
Yeah, I don't want to distract right now as we get the hour started with Phil Orlando, but John, I'm going to note there's news in Japan. We'll cover it later, folks. What you need to know is a demonstrably weaker yen against the euro. It's just something to watch. It's tangential to a Friday debate, but it's there.
Lisa, there's going to be a big policy review at the BOJ.
Yeah, is this dovish? Is this hawkish? We'll debate that probably for the year to come. Today we do have ongoing earnings, although less than this full week. Now, we are now more than halfway through this earnings season. This morning we get Exxon and Chevron before the market. This might give us a better sense of whether we're accelerating or slowing down in terms of economic growth based on what they say, based on oil demand. Also, the big question of China. How strong is that growth? 8:30 a.m. To me, this is the big data point. It's not personal income. It's not personal spending. It's not PCE deflator. It is the employment cost index, which comes out every quarter and is expected to reaccelerate after decelerating for a couple of quarters. This is a big concern. This might really push the Fed's hand, and this is a reason why this actually could be the most market-moving kind of figure that we see. And also today, this is going to be fascinating. At 11 a.m., the Fed is going to be releasing supposedly this review of what happened with Silicon Valley Bank, what happened with its oversight. Michael Barr, the vice chair for supervision for the Federal Reserve, is leading this up. It was due by May 1st. How much does this change the conversation in terms of confidence, John? Because we've seen kind of a stability in terms of pricing of regional bank stocks, albeit no rebound. But do we get a better sense of confidence of whether there are other shoes to drop, how much the Fed really has a handle on this?
Need some clarity on the regulatory failures across the board here, across several banks. Bramo, thanks for that. Looking forward to that report from Michael Barr a little bit later. Joining us now is Phil Orlando, Chief Equity Market Strategist at Federated Hermes. Phil, wonderful to catch up with you, sir. I want to go back to the question we started this program with, just how much momentum is in this economy from Q1 going into Q2 and looking out through the rest of the year?
Not much. That you look at the GDP print yesterday at 1.1%. We were at 1.3. I think we were at or near the low on the street, so that was a tough number. And regardless, our view is that the first quarter of GDP is going to be the high water mark for the year. We're expecting negative GDP prints in the third and the fourth quarter of this year. There are some folks that are looking for negative prints the beginning of next year. So our view is that economic momentum is going to be downshifting here over the course of the next year or so.
Phil Orlando, I want to talk about sell in May and go away. You have an arc of the market, an arc of many Mays that were successful and many Mays and summers that were less than successful. What is the character of sell in May and go away this year?
I think it's sort of negative, that you've had a very powerful 6-month rally that's taken the market up about 20% here from the mid-October lows last year into the 4,200 level we've seen here just recently. As we look out over the next couple of quarters, you've got inflation that's still sticky, questions about how persistent, how hawkish Federal Reserve is going to be. Earnings are decelerating, questions about recession, questions about the impact of banks tightening their lending standards, reducing their loan volumes. And then you've got the whole, debt ceiling issue that'll probably, come to fruition here in the third quarter. So for all those reasons, our guess is, the market will probably grind lower over the next 6 months.
Lisa, Ben Laidler of eToro this morning with an absolutely brilliant many-decade history of this cliche, sell in May and go away. His answer is it's valid, and he really speaks of the mystery of the summer doldrums this year.
Well, I think everything's been a mystery, frankly. 2023 could be chalked up as a full-on mystery. And one of the big mysteries is what playbook do we whip out? And Phil, when you're talking about some sort of downshifting in Q3 and Q4, is this a recessionary playbook or is this a stagflationary playbook?
Our view is that we don't know. We're going to be data dependent, but right now, the title of my presentation for clients this year has been Recession Watch for 2023. We're watching the data as closely as anyone. And again, we've got negative GDP prints in the third and the fourth quarter of this year. I've seen some economists with negative GDP prints in the first half of next year. So somewhere, within those winter months, we're going to be coming up to that razor's edge of whether or not the economy slides over the edge in a recession.
Phil, as you know, the market is not the economy. So can you give me the market call, equity leadership, which pockets of stocks you want to be in?
Well, if we're right that this 20% 6-month rally here reverses over the course of the next 6 months, then I think the answer to, we've got the NFL draft going on. I think we want to keep the defense on the field right now. So we like cash, we like treasuries, and we like defensive equities in stable demand categories. So large and small cap value stocks and international stocks have low PEs, low betas, high dividend yields. So our mantra here is let's hunker down, preserve some capital until we've got some clarity on some of these issues we've just talked about over the next couple of quarters.
I can't get you to bite on the rally in the home builders on the S&P 500, Phil.
The home builders have looked impressive here over the course of the last couple of months. We've been in a housing recession for the last 7 or 8 quarters. There's still tremendous pent-up demand, and the home builders have done better over the last couple of months. How sustainable is that? If the economy goes into recession, we'll have to see. But the home builders look attractive here, no question.
Something's got to give. Just amazing. Phil Orlando of Federated Hermes. Phil talking up recession risk and at the same time likes what he sees in the home builders. Tom, can you reconcile those two things for me right now?
I can, and I think Phil, with all of his experience, said the same thing. Nobody's reconciling anything right now. And I'm going to go back to the highlight so far this morning, which is Lisa talking, what was it, Lisa, plus 12 on Amazon? -2, total 14-point swing. How often does that happen with a massive company like that? Never.
Rarely.
That's where we are.
Rarely. And it's about a loss of momentum from Q1 into Q2, which is the economic question of the day.
It's like Manchester United, 2 goals up, and I mean, it's sealed, they're gone, they're home, that's it, and boom, Al Arian, emails me, do you have Al Arian this morning?
We'll catch up with Mohammed at 9 o'clock.
What the hell's that about? Why don't we have him here? He won't get up that early?
I think it's because you interrupt the conversation every
That's
time
probably
he comes
why
on.
it is. I interrupted here.
That might be the reason.
He sends me in, he says the Tots came back big time, same idea,
Did you watch that game?
I watched the highlights of it. I did not get to the game.
Spurs were impressive in the second half.
The second half.
Created some opportunities.
You know what I love? Relegation.
I know you do.
I would love to see baseball relegation.
Who would you like to see relegated in Major
Whoever,
League Baseball?
the Kansas City Royals and the Oakland A's would be top of the list.
You'd like to chop them up?
No, right now in the standings, that's where they would be. The New York Mets, Lisa, would not be relegated.
Maybe, depending on the year. Some years they might be.
The Jets?
The Jets in baseball would be relegated.
Tom, I think you know I meant football. Aaron Rodgers, you got any comment on that?
It's fun. I mean, the Jets have been such an embarrassment for so long that it'll at least be fun, be exciting. Yeah.
They're not one of the favorites for the Super Bowl now?
I don't have the knowledge base to go there.
Well, this was great. So we won't do sport
I'm watching
again
Formula
today.
One. Baku, Pierre Grossley doing well this morning.
Okay. Do you want to squeeze in another sport, a bit of basketball?
No, I'd say on Formula One. It looks exciting.
Simi Shah in the next hour on the equity market and not sport. That conversation just around the corner.
Nothing, Knicks? No. Keep the sports talk going. Keeping you up to date with news from around the world with The First Word. I'm Lisa Mateo. Well, House Speaker Kevin McCarthy stepped up his demands for President Biden and Democrats to avoid a debt ceiling crisis. McCarthy told Bloomberg TV they should embrace the plan that House Republicans passed that includes spending cuts. He said he's willing to make a deal.
You know what happens with a compromise? We can get something together. It's what I sat down with the president the very beginning in February 1st. I said, Mr. President, why don't we sit down and work through it? There's two things I will not do, Mr. President. I will not raise taxes, and we will not pass a clean debt ceiling. But we can talk about everything else.
The president has rejected the idea of a debt limit bill that also cuts spending. The Bank of Japan has scrapped its guidance on future interest rate levels at its first meeting under new Governor Kazuo Ueda. At the same time, it's keeping its main stimulus measures unchanged in pursuit of stronger inflation. That keeps the BOJ in a very different place than other central banks who are fighting rising hikes. And Russia launched a wave of missile attacks across Ukraine early today. The capital city of Kyiv was hit the first time it's been struck in more than a month. Explosions were also heard in 5 other regions. At least 12 people were killed. Ukraine says it shot down 11 cruise missiles and 2 drones. Amazon jolted investors with talk of a slowdown in cloud computing growth. The company's most profitable division saw a 16% gain in revenue in the first quarter. That's the slowest growth rate since Amazon began breaking out the unit's sales. Amazon is the largest seller of rented computing power and software services. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
DOJ or other authorities
Could face bigger challenges.
Next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Earnings season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The bottom line speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
One of the things I've learned about Amazon, and it's been documented by, I think, your Brett Stone and others, but it's such a cellular organization. They have ways of reinventing themselves in ways that I don't think are widely appreciated. So I have some confidence that they can actually continue to find ways to grow in ways that we just can't expect.
Well, it's Brian Weiser of Madison and Wall. Love to catch up with Brian. I have to say, though, come on. The fact that an e-commerce company has become so dominant in cloud, I think we all appreciate the way that Amazon has reinvented itself. It's phenomenal. that an e-commerce company has become so dominant in a business that should have been
agree.
dominated by other firms.
Other ones should have been there, and they weren't, and it really speaks to, I think, the vision they had and the method that they use, which is to cut costs along the way as their customers use the product more and more.
How much does that cap its potential growth in this cloud unit, though? Because how many commerce companies are out there, or retail companies, that are going to say, do I really want to use the Amazon cloud service? Does this actually give Microsoft a leg up from a competitive advantage standpoint?
I was more thinking about the lack of IBM not being in this market in a dominant way. The fact that it came from Amazon and it didn't come from IBM, I still can't make sense of that, Tom. Can't make sense of it.
The scars of my youth, one of the advantages of gray hair, and our next guest probably avoided this, is we were all deluded by page 3 of the IBM annual report, which started every year with a free cash flow analysis that everything was fine, fine, fine. And Tom Keene and a lot of other people were wrong. Really important observation.
They missed a massive growth opportunity.
They missed strategic opportunities.
In a rather large way. Let's get to some earnings. It comes from Chevron. First quarter EPS, adjusted EPS, $3.55. The estimate, $3.38. The number $3.55. The estimate, $3.38. They break this down between upstream earnings and downstream earnings. Upstream, $5.16 billion. The estimate, $5.17. Downstream earnings, $1.8 billion. The estimate, $1.56 billion. I wonder if that number there, Lisa, will get the attention of this White House a little bit later.
Basically, their input costs and the earnings from that were not as great as what they sold, perhaps at the pump, which is potentially a problem for the White House.
Cash flow from ops, $7.2 billion. Adjusted cash flow from operations, $9 billion. We'll look for a CapEx number in just a moment. Tom, Exxon later this hour, so look out for that. Chevron just about unchanged in the free market.
What they're looking at is West Texas Intermediate. We haven't talked about 74.95's had a moldy week. We're not on a 60 watch on an American barrel of oil, but that would change the dialogue to say the least. This is a great pleasure. Stefan Slawinski joins us now with BNP Paribas, and it's real simple. He's got that unique thing. All of you with kids at home are opening college acceptance letters right now, and you're going, oh, well, should we do major, minor? Pennsylvania invented the triple major, and Slawinski, as an undergraduate, was one of those rare beasts with 3 degrees out of one institution. He's an odd duck. Stefan, congratulations on software and BNP Paribas. I love what you say about Amazon, which is they're just beginning to climb the hill of cash flow recovery. How did they get back to a free cash flow that was COVID-like?
Yeah, hi, Tom, and thanks for having me on the program. Yeah, I mean, free cash flow has been a problem for Amazon the last couple of years. Last year, they had $12 billion of free cash outflow. And really, there's 3 things driving that. One is obviously weak profits. And so we're starting to see some improvement in operating profit coming through, but it's very slow. But, you know, inflation headwinds should ease. Supply chain headwinds should ease. The second thing is the working capital movements. So again, the last 2 years, they had $20 billion of working capital outflow. Again, we should see that improve this year. As I mentioned, those supply chain challenges should be easing, which should help working capital flow. But we haven't seen it yet. Again, in Q1, they missed big time on free cash flow with negative $8 billion. And then the third thing is CapEx. And again, that's really spiked to $60 billion last year. They did say last night that we should see a decline this year. However, some of those savings are being put back into AI, of course, and that's another sort of CapEx driver to come for the future for this company and for others.
Stefan, Lisa's got some important immediate questions. I want to do a look back here and rip up the script. What kind of Amazon did Jeff Bezos leave Jassy and the rest of them? Do you blame Jeff Bezos for what they've been through in the last 12 months?
No, of course, you know, since the company was founded, they've always made big bets, and some of them have paid off and some of them haven't. Amazon Web Services, as you were just discussing, is one of those big bets that did pay off. Clearly, if we go back 12 to 15 months, Amazon made a bet that the Omicron variant would trigger a sort of another COVID-induced demand cycle in 2022, and that didn't play out. So they found themselves caught offside. But I think maybe the market is underestimating that at the beginning of last year, Amazon made some very important strategic decisions about how to run the business in the future. And I do think that they're making efforts to get this business overall to sustainable profitability, even through a cycle. So that's whether we go through a recession, whether we go through inflation. Again, it's just taking time to see that come through. And I think that's the frustrating thing for investors is the market always seems to be ahead of itself on this one, a bit too ahead of itself. And despite all of the literally dozens of headlines we've seen over the last 12 months around shutting down divisions and cutting costs and exiting leases, we're still seeing an EBIT for the consumer business at essentially zero.
Stefan, you're generous in saying that the market seems to be ahead of itself. Other people would say it's crazy right now. It's absolutely nuts and irrational when you start to see, $100, $200 billion swings in stock valuations in just hours based on a couple of phrases, a couple of words, not necessarily even forward-looking projections. So what do you draw from that level of volatility that we're seeing in some of the tech shares, really exemplified by Amazon in particular?
Yeah, but I think that's a question around the broader market right now. Obviously, big tech always seems to tick a lot of boxes, whether it's the flight to safety this year because of some of the challenges in the financial services sector, whether it's some companies clearly struggling with growth and others able to power through that. We saw Microsoft this week power through some demand concerns with price increases. We saw Google this week power through with strong search, and obviously results last night from Snap and Pinterest just make those results that much more attractive. But at the same time, you have nervous investors. People are looking at some of these valuations on some of these big tech names, and these are positions that are the biggest in their portfolios, and they're nervous. And so, when we do see any sort of negativity, we get quick drawdowns, but also we see people not wanting to get off the bus because if these are the only games in town, if these themes, the AI theme, continue to run, they don't want to miss it. And obviously, you can really be hurt by underperformance by being underweight just a few of these big names.
Stefan, thank you, sir, for weighing in. Stefan Slowinski there of BNP Paribas. On some of these moves we've seen here today, I don't know if you'd feel nervous being in Meta. I've been riding that one up by close to 100% year to date. I think some people in that name, Tom, thrilled about the performance they've had so far.
And the Bears would say, well, it was a bounce off the mat. And of course, they're going to reaffirm some form of intermediate bull market that becomes a bear market trend again. But yeah, I just think it's almost like a cacophony. It's almost like a resonance, an oscillation that we're under, and we're living that guest to guest.
Yeah, never mind the fear of missing out. You missed out. Year to date, the rally's been absolutely phenomenal.
You've made back, on SPX, you've made back half your bear market. And the NASDAQ, you're there. Like you say in Meta, you've done it.
Can I return back to Chevron? And thank you to Kevin Crowley for writing up this story. The refining story is just phenomenal. $1.8 billion during the period from their fleet of refineries, exceeding expectations. And this stat right here, a 5-fold increase from the first quarter of 2022. Lisa, I know the stock's only up by a third of 1%, but just looking through those numbers, that refining number is pretty phenomenal.
Especially at a time when that really has been one of the key tension points around getting gasoline, let alone the oil prices being where they are and being actually a little bit more suppressed. If you have a lack of refineries, and we've talked about this, it is a closed market. If you're in it, you can really get those profits. But Washington, D.C. is going to be the real question.
Who wants to build a refiner right now?
No one.
Who wants to invest that
money?
My
backyard.
No, not in your backyard.
No,
You've got space in your backyard for a refiner.
I do. Yeah,
Maybe.
That bill's going to be on it.
Stock is positive by a third of 1%. Exxon later this hour.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, aren't you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Live from New York City this Friday morning. Good morning. Welcome to the program. Getting you to the weekend with your equity market a little bit softer, lighter, lower, down, negative 0.3%. Was that a good drink? You seem so happy with yourself after having that.
Yeah,
what was that face? I wish we could have got that on camera.
You don't know what Sanka. You have Marmite. We had Sanka when we were kids. It's like a.
It looked like Marmite, Sanka, right?
It's in honor of my mother. I'm having Sanka today.
Okay, we're negative 0.3% on the Nasdaq 100 on the week so far. The S&P 500 pretty flat on the Nasdaq, doing better than good off the back of some solid earnings. We'll see if that turns around a little bit later. Just to round things up in the bond market, then I want to get you some earnings from Exxon. Looking at the 2-year, would you believe it? On the month of April, the 2-year, if I told you, was basically unchanged. The 2-year yield is higher by just a couple of basis points on the month so far. I can tell you the high was 428 for April. The low in April, Tom, 364. That one's been all over the place right now, just a little north of 4%.
Yeah, the trophy for April's got to be the difference between the Treasury bill, the 3-month paper, John, and the 10-year Treasury note, the benchmark. And we moved out the massive inversion of near 170 basis points. All you need to know, folks, is back 30 years, that's never happened. With these sky-high elevated short-term rates and the bid on paper and lower yields farther out, that's about the only story I can glean here as a bond trend.
I promised you some Exxon numbers, and then I'll return to the FX market and give you the roundup on a single currency. Exxon, first quarter adjusted EPS 283. The estimate 263. Tons of headlines. Lisa's looking through them. We're negative 0.6% on Exxon in the pre-market. They say they're on track, Lisa, to buy back up to $17.5 billion of stock during the year.
They also say that their total revenue in the first quarter and other income was $86.6 billion. The estimate was for 84.6 or about billion. So a significant beat. And this is what's interesting to me. We talk about CapEx, how much our business is actually going to invest. They expect capital expenditures to be about $23 to $25 billion versus the estimate of $21 billion. So how much is this a nod also to the government saying, okay, we'll invest more, we'll do more, look at that. We can cross off those particular issues and then continue to make bank, which is clearly what they did.
The energy names have had a phenomenal couple of years. A bit of a struggle, I have to say, year to date relative to the boom we've seen in tech.
Yeah.
Backing away a little bit here, Tom, in the pre-market, negative 0.3%.
Let's put things in scale. We got to get to an important guest here, John, on foreign exchange. You've got free cash flow looking out 24 months on Exxon, call it $40 billion. That's less than double Apple's $100 billion. 40 billion free cash flow Exxon. That's how puny they are to Apple at 100 billion plus.
We'll return back to the energy story in just a moment. I want to sit on foreign exchange just briefly. High of the year. We got a new high of the year a little bit earlier this week, 110.95 on the euro against the dollar. A break of 110 now, though, negative a third of 1%. The dollar making a bit of a comeback here at 109.90 on the euro against the US dollar. Here's the Goldman Sachs view of things. They write the following: the euro is trading close to our year-end forecast for the second time this year. We think ultimately the upside is capped because the space for divergence is fairly limited. Underlying economic conditions are not all that different, but it should be noted that the euro is certainly holding up its end of the equation rather well, while there are more question marks, Tom, on the dollar side.
Right now, we're going to do this with Camacho Trivedi, and it's very important here to track the euro into what we see across this globe. Camacho, all the focus is on euro, dollar, euro in the United States, and yet we see so much about Europe and a new Pacific Rim. You center it out is euro and Japan, which is a traditional big pair, and less obscured euro renminbi or euro China. Which is a more intelligent way to look at this, euro Japan or euro China?
I think they're both picking up important aspects of what is going on. You mentioned earlier about how the two-year rate in the U.S. has been pretty much range-bound for the year. When you look at the broad dollar, that's been pretty much flat for the month of April as well. And, you know, part of that is that there are big differences going on underneath the hood. The fact that euro has had some, solid reasons why it is trading as strongly as it is. The nominal GDP news in Europe has been pretty good. At the same time, you had, weakness in North Asia. That includes the yen, given another, fill-up by the, relatively dovish meeting today that we got. But it includes CNY, which has been underperforming. It includes the Korean won as well. So I think the real story in FX markets over the past month and a little bit longer even has been this sort of twist underneath the dollar, which is what has happened in Euro Asia.
When you look at Asia, the core issue here is China growth. Some the Goldman Sachs view on the durability of 5 or dare I say 6% China GDP, and then what does that do to their renminbi policy?
I think the growth view here is that the easy part is done, right? Like we've had the stellar rebound from the COVID shutdowns in the first quarter. That was stronger than many people expected. I think from here, it would not be surprising if you saw a slower pace of growth as we go back to something like trend. And the remaining parts of reopening that are left, things like international travel, as that picks up, that's not going to be a renminbi positive. If anything, it's going to boost the service sector deficit of China. It's a better tailwind for something like the Thai baht, which tends to benefit a lot from international tourism. So I think the sort of growth tailwind to the CNY is done and is part of the reason why, given the low inflation, the punitive negative carry as well, the Chinese currency can continue to be a sort of funding trader on the short side of a lot of EM carry trades.
Taking a step back, Kamakshi, a lot of people thought of China as was sort of the sun of this year, the sun of economic growth that was shedding some warmth on Europe, and U.S. was further away, so it wasn't getting as much of that. And you saw that reflected in some of the performances of certain companies. The closer they were to that sun, the better they did. How long can that keep bolstering the euro versus the dollar, based on the fact that, as you say, it seems to be waning a bit? It's already been priced in.
I think that's right. I think it is waning a bit, and I think also, if you think about what the factors that have been supporting the euro, the kind of high inflation, fewer worries on the growth side or banking issues that have been sort of plaguing the U.S. to some extent, all of those have been supporting the euro. Some of them can extend a little bit further. We're priced, or the market is priced for the ECB to hike, more substantially than the Fed over the next 6 months. But I think we are coming closer to the point where Europe also has its inflation relief moment. That's a good way for some of the support for the euro to sort of be somewhat diminished. And we haven't quite seen any of the stresses that you traditionally see in Europe when you have a policy tightening, things like sovereign spreads and so on. So, I think it makes sense what the euro has done given what is the news we've had. But I think there are limits to this divergence with the US.
Looking ahead to next week, that divergence will be on cold relief when we see both the Federal Reserve meet as well as the ECB. And it strikes me that both regions are kind of heading into a stagflationary kind of environment because, yes, we might be hitting a tipping point, a downward trajectory with inflation, but growth is coming in and inflation is still too high. What is the playbook for some of these central banks given that kind of backdrop?
I think ultimately, the playbook is not that different across different central banks. I think there's a difference in timing about when they move. But you've seen even this month a number of G10 central banks, whether it's the Riksbank in Sweden, whether it's the Bank of Japan today. We've seen somewhat more dovish shifts, or at least dovish commentary from these central banks. I think in many places it looks like disinflation is progressing, but progressing only slowly, and the central banks want to pause or want to step down the pace of tightening that they have been delivering. I think we'll hear something similar from the Fed next week. I think the ECB may take a month longer before they get to that point, and I think that's the near-term divergence one has to be careful about. But ultimately, we don't think these central banks or these macroeconomy, are in such different places.
Hardly talked about the ECB going into next week. Kamasha, thanks for your time, sir. As always, Kamasha Trivedi there of Goldman Sachs going into the Federal Reserve May 3rd, May 4th, the European Central Bank decision. Here's the word from Subhadra Japa over at SocGen. Not so fast. They go on to say, the Fed is widely expected to deliver its last rate hike of the cycle as the ECB catches up by delivering a 50 basis point hike next week, taking us one step closer to the end. But here's the important but, Tom. Global inflation woes are far from over. Data dependence implies greater vigilance and more volatility in global rates. And then with this, buckle up. Buckle up is the word coming out of SocGen.
Into my weekend reading, of course, they've got a wonderful view from Paris, but into my weekend reading, these are not apples and apples. The inflation character across all of continental Europe and the United Kingdom is totally different than the United States. I don't think the dialogue of Frankfurt and Washington is even remotely the same.
What do you think is different about it? What's most pronounced for you?
The confidence in the United States, for whatever reason, that we can get down to where Ed Hyman is on 3% or less inflation, the Steve Major discussion, the David Rosenberg discussion. I don't hear that discussion in Europe.
Is the labour market, Lisa, pushing back against that view?
That's the issue, right? And that's been the key distinction over in Europe, where you see a lot of the strikes, a lot of the protests with respect to labor, trying to get more benefits, higher wages. Is it really so different in the U.S.? And we'll see with the ECI coming out in about 2 hours, a little bit less than that. How much really is it different? Don't we see those employment cost indexes going up, especially for the people who actually go out and do stuff, and the line workers?
Don't you think to some extent that people are just exhausted by some of these conversations?
Yes.
Just totally exasperated by going into next week. Then there's a feeling that they're almost done, but there's a feeling that they want them to be almost done.
Are you talking about yourself?
Oh, without a doubt. Straight up, I'm talking about myself.
100%. I'm right there with you.
And everybody I talk to about the same thing.
To the emotion that we're in the clarion call Monday morning of sell in May and go away, if you want to sell in May, you got to be in the market. And I believe most of the statistics tell me most people aren't enjoying this market.
Yeah.
So there's nothing to sell in May if you're not in the game.
I'm not sure how many people enjoyed that run up in Meta.
Yeah.
Almost 100%.
Yeah, but the market in general, I mean, basically the SPX has made back half their bear market.
I'm just thinking, are you not entertained? I feel like the market is coming to us and saying that again and again. I mean, it's not a fun market because it's just sticky and back and forth. And, we talk about, you're saying, will the momentum continue into the second quarter? You're saying, do you sell in May and then go away? And I just wonder, what is the playbook that we're heading into, right? Are we heading into some sort of recession? Are we heading into stagflation? What do you do with that as a trader after not having seen that?
What you do with it right now, folks, is look to the Bremo newsletter. It's been a hit for April. Do you think that it's got legs for May? I think it has. I think build out as
that's
well.
The one thing right now that's got some real momentum.
It does. It's the only thing here that's got real momentum.
The only thing on this program that has, given our performance so far this morning. A little bit later on this morning, Lisa mentioned it, 11 a.m. Eastern Time, you are going to get Michael Barr's report on the collapse of SVB, the Vice Chair for Supervision over at the Federal Reserve. And that's going to be a key one a little bit later on today. Equity futures, negative 0.4% from New York. This is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. Speaker Kevin McCarthy is putting the pressure on President Biden and Democrats to embrace his plan that was passed on the House floor in order to avoid a debt limit crisis. In an interview with Bloomberg TV, he said the president is putting the economy at risk by avoiding a negotiation. Biden opposes the measure because it includes sweeping spending cuts in order to raise the debt ceiling. In China, the Communist Party's Politburo said the country's economic recovery needs continued fiscal and monetary support. It also warned that domestic demand is insufficient. The Politburo is the top decision-making body led by President Xi Jinping. In the UK, Prime Minister Rishi Sunak's government has signaled it will break its pledge to scrap laws from when the country was in the EU. That could enrage Conservative Party Brexit supporters. Sunak had promised to review or get rid of all the laws by the end of this year. Instead, the government suggests it will scrap just a fraction of them by that deadline. Shares of Intel are rising. The embattled chip maker has promised a recovery in the second half of the year. That prompted investors to look past a disappointing profit margin forecast in the current quarter. Intel said it's returning to full manufacturing capacity, and an inventory glut affecting the personal computer market is coming to an end. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
The Fed took rates from 0 to 4 3/4% in 12 months. There are consequences. It's not just, okay, Silicon Valley Bank is signature, and we get up and dust ourselves off and ride off into the sunset. There are more consequences. Might it be another financial institution or two? Could be. My view is it will include a mild recession. Hopefully it's only mild.
It's the beginning of a process. That seems to be the view of Bob Dole, the CIO at Crossmark Global Investments. We caught up with him just yesterday. Looking forward to the conversation on these issues with Mohammed Al-Erin a little bit later this morning. We'll do that in a couple of hours on Bloomberg TV. Elsewhere in the market, equity futures, negative 0.4% on the S&P 500. Looking at a bond market with yields lower by 4 or 5 basis points on a 10-year, 347.30. TK, what have you got?
What do we got right now is a headline, and it is a simple headline, and this is breaking news and maybe speaks to getting ahead of Labor Day in the autumn. Lazard to cut about 10% of workforce. Usually the cuts, John, are a constructive 3%, 2%, 4%'s big, 10% is not 4%.
And what they're saying really about the outlook being uncertain, I think speaks to what we've heard from some of the big players on Wall Street too in the investment bank about what's been happening with M&A activity. Lisa, slow M&A activity resulting in significantly lower revenue. Speaking to what we've heard from elsewhere.
This is what we've seen pretty consistently, and it really raises this issue of how important it is for banks to be large and have lots of different segments that offset one another. We saw from the biggest banks that, yes, they expect M&A volumes to continue to go down, but they have big investment banking revenues, they have the big consumer banking revenues, and that offsets it all. This is the larger question of how big does a bank need to be successful at a time when politicians are kind of warming up to the idea that big is better, ironically, this many years after the crisis.
Financial advisory revenue, Tom, $274 million, the estimate $296. I would suggest that is a bit of a downside surprise there. Asset management revenue, $265 against an estimate of $262. I'll keep going through the numbers, Tom.
Ken Jacobs driving the ship here as Chairman, Ray McGuire as well. Let's remember this is 3,400 employees. It is a small shop, maybe like the beleaguered First Republic Bank, not to compare them to. I believe Lazard is providing advice in some of these banking dramas that we see now. We get lucky with the news from Lazard for Global Wall Street on radio and on television. Myra Rodriguez Valadares with us now of MRV Associates. We were scheduled to talk about, should I do my passbook savings book account at this bank or that bank? Forget about it. Myra, you are experienced in Global Wall Street. Will we see the larger firms mimic what we see this morning at Lazard?
I think, unfortunately, you are going to be having some layoffs, even at the globally systemically important banks. You do have a slowdown in mergers and acquisitions. All of the big banks showed that in their earnings in the last couple of weeks. You've already had some very large consulting firms, tech firms laying off people, and so it is. You know, the labor market is still tight, but you are starting to see some softening, and that is definitely going to impact banks of every size, I'm afraid.
You're too young to know. I remember this clear as a bell, and let's go to E.F. Hutton just as one example. But when things get tough, combinations are in order. We all learned that from Andrew Mellon a few years ago. Can you predict with the challenges that Lazard speaks of this morning that we will see constructive combinations over the next 24 months?
Yes, I think you are going to have layoffs, and it is going to have to be done very, very carefully. Unfortunately, what we've already seen is that there's a lot of high earners who are being laid off. And so that is going to impact states. It's obviously going to impact the broader economy. I'm hoping we're done with the banking turmoil soon. I think First Republic is going to be, and it is being worked on right now, and that was the bank that has suffered the greatest amount in terms of loss of deposits. But I'm really hoping that we're coming to the end of this. However, the large banks and the independent investment banks like Lazard's are still being affected by what's happening in the broader economy. There's no way to escape that.
Myra, is there an irony to all of this that however many years after the great financial crisis, the biggest banks are viewed as the best and actually have the most favor in Washington, D.C. right now when it comes to looking like stalwarts through turmoil?
Right. I mean, there is a bit of irony, but what we have to remember here is not that they're big. I mean, yes, of course, that helps. What really helps these institutions is that they are so incredibly diverse. They have retail banking, commercial banking, asset management, custody, of course, broker dealers. And that's really what's helping JP Morgan, Citibank, Wells Fargo. When you get to the regional banks and even smaller, they are just nowhere near as diverse, both in their assets and in their liabilities. And that's really what's hurt banks like Silicon Valley, Signature, First Republic. And so it shouldn't just be that they're large. What we need to be looking at is how diverse are they? That's really what's going to help them get through this storm.
We've talked on the show, and John has really said well about how people are averse to saying crisis in this particular capacity, except harkens back to 2008. And yet it seems like there is a slow rolling problem in some of these regional banks that isn't going to go away overnight. And I was struck by yesterday's data from the Fed showing an increase in the emergency borrowing from the discount window, from the emergency lending program that they just started up. Is your sense that this slow-moving kerfuffle, or whatever you want to call it, is continuing to accelerate under the hood, taking out some of the biggest problem children?
Yes, no, I mean, it is significant, serious banking turmoil. There's no way of denying that. And unfortunately, it has to do with quite a number of regional banks that forgot the basics of banking, which is to always be identifying and measuring your interest rate risk and your liquidity risk. And every single bank regulator has it on their websites that it is essential for all risk managers to always be monitoring interest rate risk. I realize that for anybody who's just come on board onto Wall Street or the City of London in the last couple of years, they'd never seen an interest rate rise. I get that, but it's banking 101, right? Interest rates go up and they do come down. And if you can't manage that, you shouldn't be in banking.
I'm not sure it's the junior analyst in London that needs to be told about that, or on Wall Street. Maybe it's the supervisor, Mara, because the supervisory failure over all of this has been phenomenal. Just to look back, when we get the report from Barr a little bit later, what specifically you expected to see in that?
I'm not going to be surprised at all that you're going to find out that there were lots of supervisors who did know that this was going on. We have to remember that off-site bank supervisors and bank examiners can't get on Twitter or come on this program and explain what's been going on, right? They're not allowed to talk to the media. And there were many of them who have known. The question is, what happened at the very top? And we did have a couple of years before this current administration where it was very much a hands-off, these banks. The tone at the top was very different from what we have now. And so unfortunately, this is all caught up, and it is a real problem. You do need to empower middle level and other bank examiners to do their job. The problem is that if the tone at the top is hands off, then that filters down. It's a real problem.
It goes back to the chairman all over again. Mara, thank you for being with us. Mara Rodriguez, Valladares of MRV.
It's amazing our booking could do that. They could, get my run right when Lazard comes out.
Conversation a little bit later. I have to say this. I understand why people don't like the word crisis. I understand that it's not 2008. And understand there is a duty when you're talking about these things not to stoke fear. I get all of that. But when you get a failure of SVB, Silvergate, Signature, Credit Suisse, idiosyncratic,
until
the question I'm asking at the moment is, okay, if that's your view, that's fine, and that seems to be the consensus view. I'm not here to interrogate that. I want to understand how many more banks would need to fail before you would sit there and say that it's not idiosyncratic, that there is a broader issue at play here that's going to lead to some broader problems in the future.
The issue here is also, how do you draw the distinction between perhaps not a wholesale cascade of failures, but perhaps this sort of slow grind of one bank being acquired by another in a forced sort of merger, lending coming in, something that could affect the economy much more and is harder for, say, Fed officials to come in and stop with monetary policy the way they did in 2008. So it could have actually a longer lasting lag on the economy in a way that perhaps is difficult to price in or even extrapolate out.
You mentioned sequential becoming from idiosyncratic to mainstream. I would say, and I borrow this from Hilarion in game theory, going back to Frank Ramsey, the unknown is what's out there. And you get a respect for that after you screwed this up incalculable times like I have.
Seeing stability.
Unknown unknowns.
Seeing some stability, but that doesn't mean the story's over. In the equity market, the S&P 500, negative 0.4%. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
People talking about a slowdown in the economy, except the S&P sits at 4,100.
I do think that there is a danger that tech can't continue to do the heavy lifting for the entire market here.
Broadly speaking, businesses are anticipating a slowdown in the economy.
All those lead indicators pointing to slowdown/mild recession. I don't see how we escape it.
I really do think that the data are going to have the Fed hiking further.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market negative 0.4%. It's been a monster week for big tech. It continues into next week with Apple on deck. Later on next week, with the Federal Reserve and ECB decision somewhere in between. The Federal Reserve next Wednesday, Tom, on Thursday, the ECB. Then after the close that day, we'll hear from Apple.
We'll hear from Apple as well. And I do take the point, it's a busy week, but I think it's a week after the exhaustion of April. Do we get clarity in May? Can we say that May maybe will provide just an overall theme that was missing this month? It can't get worse than this, can it?
There is one report in May that we've spent the whole of April talking about, and that is the Senior Loan Officer Opinion Survey that will be released in early May, that the Federal Reserve should, Lisa, have in hand when it meets next week and presents perhaps some of the ideas that come from it in the news conference. And I think we go back to the original question in March and have to keep on returning to it. To what extent will this stress be a substitute for rate hikes? Will they have an answer next week? I doubt it. Will they be closer to an answer? Maybe. This could take weeks, months, maybe even quarters.
I could feel the frustration in your voice as you think to yourself, we're going to be asking the same thing for the next 2 months, 3 months, and have no answers, and be asking the same questions, and everybody will. Is this, though, and I keep going back to this, yesterday I was asking about this as well, is this basically the economy that called wolf, right? How many times can people say, okay, it's going to be a recession, it's going to be bad, it's going to be bad, and then it just is good, 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 and then people aren't prepared for when it actually sours, but it's going to eventually sour.
Momentum. Have we lost momentum? Overwhelmingly, consensus seems to indicate,
What,
Tom,
First Republic?
we've lost momentum. No, in the U.S. economy. From first quarter into second quarter.
I think, yes, I think we confirmed yesterday, and, you see a little bit of stagflation out there in the research reports, but, yes, we didn't get the enthusiasms that we thought we'd get yesterday, and we still got to get revisions on that.
Amazon's guidance speaks to that as well. Losing momentum from the first quarter going into April, a loss of momentum. But then there are all these little pockets of tension for me. The idea that we've had a 70% rally off the June lows on the home builders on the S&P 500 does not scream recession to me. Does it scream recession to you?
It screams rebound, which is what you're maybe seeing actually marginally in some of the data. Honestly, getting any clarity right now is very difficult. People are looking right now to get a better sense of what's going on in the regional banks, and the latest is New York Community Bank Corp coming out with the first quarter. What everyone's keying in on, deposits come in lighter than expected, and we can parse through this. But to me, how much focus is going to be on that drip, drip, drip of what's happening with deposits flowing out of banks?
Full disclosure, NYCB has been a sponsor of all that we do here at Bloomberg Surveillance, and we thank them for their support on that. But separate, John, right on the NYCB headlines, FRC gave way. FRC's had a very constructive morning off a close of 6.19, and boom, at a 6.65, they come right down to 6.47. Not contagion, that's too inflammatory. The impact of NYCB goes across the nation to FRC.
FRC is still a bank looking for a solution. When we spoke to Jenny Montgomery Scott a little bit earlier this week, they turned around and basically said 3 options on the table here. Lisa, sell assets, raise capital, or fail. On the first 2, we really haven't heard much on the first 2 at all week.
Probably the reason why is because there's a massive tension. The government doesn't want to bail out JP Morgan, Citigroup, and Bank of America, who put $30 billion of deposits in this bank. And at the same time, unless they have some sort of support, there is going to be no sale because people need to have a guarantee of loan losses, and someone needs to bridge the difference.
Jenny Serrain and our team reports on this morning, and I think Matt Levine did a great job summarizing it up for Bloomberg Opinion. Well, my focus into the weekend, John, is not on James Dimon, not on Brian Moynihan and the rest of the cohort. It's on the government. The government here has to blink and visibly blink at some point. I don't see that yet.
They've been very quiet. Very, very quiet. You're going to get a report on the failure of SVB a little bit later. Lisa will give you the time of that in just a moment. Here's the broader price action for you. Negative 0.4% as we crawl towards the weekend. And look forward to close this one out this week so far. Yields lower by 4 basis points.
Do you really feel?
347.87. I'm going to spend the whole morning. Is it
You're
over
going to spring into poetry here at some point?
What's the whole thing about, morning TV and morning radio? You've got to be happy, all of that stuff. No, not today. Can I finish on the FX market? The euro, just briefly.
Crushing it.
Euro dollar came really close to 111 a little bit earlier this week. It's backed away since then. 109.84, Tom. What's that?
That's my.
Well, no one on TV can see that.
TV.
What is that?
It's my morning TV smile. On radio, it's.
Right, okay. You're sort of gritting your teeth. Is that how you feel about this week as well?
Yeah.
Can I?
Ramo, of course you can.
All right, let's
whatever
talk
you
about...
want to do, you can.
Okay.
Can I? Whatever it is.
A very
sure.
cheerful brief. Good morning. I hope that you all had a great week. We have gotten an earnings roll throughout the week. We did get Exxon and Chevron. Interesting that they both beat. Really, the focus is going to be probably more on Chevron than Exxon, even though Exxon shares up about 0.5% after a big beat. Chevron really delivering incredible refining profits, which will raise some headlines, raise some eyebrows over in Washington, D.C. 8:30 a.m., we get a slew of data, personal income, personal spending, PCE deflator. At 10 a.m., University of Michigan sentiment survey. But what I am watching is the employment cost index that comes out in about 90 minutes time. Are we seeing a reacceleration in wages, and what does that do for the Fed? And speaking of the Fed, 11 a.m. is the time for that review. What we get from Michael Barr, who is Vice Chair of Supervision at the Federal Reserve. He'll be releasing that. What went wrong with Silicon Valley Bank? Where are the fingers pointed? Is it all on Randy Quarles, who is no longer there, or is it also at Jerome Powell?
That was way too upbeat, wasn't it, Tom? Just way too upbeat. You keep gritting your teeth. Joining us now is Seema Shah, Chief Global Strategist at Principal Asset Management. Wishing she never woke up early this morning to join this program. Seema, good morning.
Good morning. It's great to be here.
Great to have you with us. This recession chat, what underpins it? Where's it come from? I think a lot of people might look at this situation and say, well, yes, inflation's a problem, but I'm looking at unemployment, 3.5%. Claims have ticked a little bit higher, but they've come back in again. Where's the recession chat come from, apart from maybe we're due one?
Well, so we are due one. I think the problem is that we've been talking about recession for ages and ages and ages. And as you said, people are getting a little bit tired of the discussions. But if you look around the economy today, it looks fairly strong. Yes, there's a soft slowdown happening, but generally speaking, things look okay. And I think the main reason is that the labor market is underpinning everything. But if I put my economist hat on, labour market is typically the last one to fall. It is the most lagging indicator here, but it's also the most important. So we can be watching, the lending survey is going to be really important. There is a very, very close correlation between lending data and employment. So as you see lending contract, you should see job losses increase. So we are expecting recession late this year, and everybody's kind of like keeps being pushed out. But it does look very, very likely given the amount of Fed tightening you've seen to date.
Markets are almost hoping for this recession. Bring it forward. Let's get it over with, and then we can start with the next cycle. And it seems like that impatience has been embedded in all of the bearishness that we've felt. What's worse for risk assets, though? A recession at this point or stagflation?
Oh, stagflation by far. That is the worst case scenario. One of the things that has been underpinning markets to this point is this idea that at some point in the next 6 months, 8 months, is that the Fed is going to start cutting rates. There is a lot of assumption out there that inflation is going to keep coming down. That is the consensus forecast, and there's very, very little dispersion in those expectations. So inflation, if it were to reignite and start moving up, that takes away everything which is underpinning the market today.
So if we get this ECI print showing that employment costs reaccelerated, which some people expect that to be the base case, what does that mean in terms of exactly what you just said?
Right, that means that the Fed's job is not done. We I think are seeing that, look, we're getting towards the end of the tightening cycle. Everyone believes that there's going to be a rate hike in May, but almost no one is talking about beyond May. The other part that nobody's talking about is not only that could they pause, but why couldn't they also return to the market in September with a new rate hike if things are not going as planned? They have said that they're very data dependent. They have said that they need to watch and see what the impact of Fed tightening is going to be. And if you're not seeing wage growth come down, and if actually you're seeing inflation really plateau at the kind of a 4.5% level, what's to stop them from doing a new rate hike? Now, that I want to clarify, that is not our baseline expectation,
Sure.
but I would put a fairly meaningful chance on that, probably more than what the market is putting right now.
You're over from London. Can you tell me, so far this week in the conversations you've had, the kind of differences that you're experiencing in the conversations here about the US versus, say, London about the US? Are they different at all?
They are a little bit different in that no one in the UK is talking about the debt limit. I mean, I find that for international investors generally, they kind of, we go through this every few years and it always passes okay. And I find that in the US, there is definitely a lot more concern. Almost every single client conversation I've had, that has come up as a really significant concern.
Who's got it right?
Can I say international?
Do you think so?
I do. I think that the chances of a default are higher than they have been previously, partly because this administration is so belligerent. And that volatility is very disruptive when the market is already very, very vulnerable to any kind of disruption. I shouldn't have said that. I don't take it back though. Okay, so that is what is disruptive. But I do think that things will eventually all get past. I'll be fine.
I'm not here to correct you either. This was wonderful. Do you want to talk about US politics sometime in the future? Next week, the week after that? We could do a weekly segment, couldn't we?
Let's save her.
I think you should always ask what the people in London think about the situation over here, because they seem to have a very, very different view on things.
That was fantastic. It was like, can I say the truth? Okay, I won't. Here's what I'm going to tell clients. It's okay.
That is interesting, though, Seema, that they seem to be shaking it off here. What do you think it is about the US-based investor and why they're so much more obsessed with it here? And I wouldn't, maybe I'm using that word obsessed loosely, why they're paying more attention to it here. Is there good reason for it?
I think this is standard of investors. You look at your own local market and you're always more negative about your own market. That goes across the board. I'm probably more negative about the UK than my US colleagues. The same thing in the US, same thing in Hong Kong, China.
Come here every day. This is Daniel from Iowa just emailed in and said President Biden is not belligerent.
Sorry.
Okay.
Seema,
Daniel's the chairman of Principal Asset Management.
Seema, appreciate it. There's no email on his screen. Don't worry about it. We're not in trouble. Seema Shah of Principal Asset Management.
If I said that, can you imagine?
We can't say that. Yeah. We can't say that. But our guests can say that if they wish. They see reason to.
Yes, they can.
They're entitled to their opinion on the administration.
You're being belligerent.
Anne-Marie doesn't have an opinion. She'll join us shortly. She'll give you the view of things down in Washington. And later, Seb Page of T. Rowe Price in the next hour. Looking forward to that conversation. In the equity market, negative 0.4%. Good morning, Mr. President, if you're watching. That was Seema Shah, Principal Asset Management.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy stepped up his demands for President Biden and Democrats to avoid a debt ceiling crisis. McCarthy told Bloomberg TV they should embrace the plan that House Republicans passed, one that calls for cuts in federal spending. He said the Senate's done nothing and the president is ignoring the problem. Russia launched a wave of missile attacks across Ukraine early today. The capital city, Kyiv, was hit the first time it's been struck in more than a month. Explosions were also heard in 5 other regions. At least 12 people were killed. Ukraine says it shot down 11 cruise missiles and 2 drones. The Bank of Japan scrapped its guidance on future interest rate levels at its first meeting under new Governor Kazuo Ueda. Now, at the same time, it's keeping its main stimulus measures unchanged in pursuit of stronger inflation. And that keeps the BOJ in a very different place than other central banks who are fighting rising hikes. ExxonMobil posted its strongest ever start to a year. Net income more than doubled from a year earlier to $11.4 billion. That's the highest first quarter profit in Exxon's 140-year history. Meanwhile, Chevron also posted better than expected results. Profits from oil refining soared. Investors are watching to see if the oil supermajors can sustain massive share buybacks and dividends despite slumping energy prices. And Amazon jolted investors with the talk of a slowdown in cloud computing growth. The company's most profitable division saw a 16% gain in revenue in the first quarter. That's the slowest growth rate since Amazon began breaking out of the unit sales. Amazon is the largest seller of rented computing power and software services. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Next week, Bloomberg is live from the Milken Conference in Los Angeles. Bloomberg's all-star team will bring you the latest news and speak to the biggest names with the capital, power, and influence to change the world.
Globalization, certainly there's areas it's retreating. It isn't dead, it's just changing.
Technological change is real, it's fundamental. But that doesn't mean the purchase price doesn't matter.
Live coverage begins Monday at 10 a.m. Eastern Time on Bloomberg Television and Radio.
You know what happens with a compromise? We can get something together. It's what I sat down with the president the very beginning in February 1st. I said, Mr. President, why don't we sit down and work through it? There's 2 things I will not do, Mr. President. I will not raise taxes, and we will not pass a clean debt ceiling. But we can talk about everything else.
House Speaker Kevin McCarthy with a big win this week with Republicans in the House speaking on Bloomberg's Balance of Power with Bloomberg's Anne-Marie. Fantastic exchange just yesterday. If you'd like to watch that in full, you can do on Bloomberg.com and on the Bloomberg terminal if you are a subscriber. Looking elsewhere at the market to close out the week, going into the weekend, your equity market unchanged through most of this week on the S&P 500, unlike the NASDAQ, which is positive off the back of some decent earnings from the likes of Meta and Microsoft. Looking at the S&P this morning, negative 0.4% on the S&P 500. Yields come in just a little bit. We're down by 4 basis points going into the Federal Reserve next week, 348 on a 2-year. Just looking at the monthly moves on a 2-year. The 2-year pretty much flat on the month, but some big ranges once again. 364, 360 something at the low end, close to 430 at the high end. That 2-year still this month, Tom, stabilizing a little bit over the last week around 4%, but still all over the place.
The first thing I looked at this morning was that 2-year yield. I will say, John, looking at Bloomberg Launchpad of equities, bonds, currencies, commodities, end of April into May, I'm looking at Euro end and the Asia drama 149.34. But I go where Liz Ann Saunders is of Charles Schwab, and this oddity, which Lisa's nailed, of short-term paper versus the 10-year note, it is an inversion. What would the 210 extrapolation be of that? Would it be 110, 120 basis points on 210? We got a substantial 3-month 10-year inversion.
2-year, 10-year right now, Tom, negative 57 basis points. And then you've got all these little kinks at the front end of the curve in T-bills.
Lisa, quickly on the kinks. What do those kinks look like? You're expert on this.
Well, at one point, it was the biggest kink, basically, 3 yields, going back to, I believe, 2001. And the thinking here was that 3-month would really bump up against the debt ceiling debate. And that's why you were seeing a higher premium on those bills.
Can I just say Seema Shaw's had more email response to an appearance than anyone in the last 90 days?
She's welcome back anytime.
It's a belligerent interview, and we thank her from the principal group for being with us. Right now, with the movement of April into May, that means that Washington is preparing for a hotter season. And if you get out the calendar, that can mean only one thing. This weekend, the White House Correspondents' Dinner. We will be honored to attend with our chief social correspondent for Washington, Anne-Marie Horton. Anne-Marie, there's a pomp and circumstance to it. There's different parties in that. But the reality is the president is greeted by the press, print, TV, radio, and the rest. They're greeting him after the oddity of an election announcement on video. How will the president be greeted this Saturday night?
Well, you've been to these, of course, Tom, many a times. I actually think you're more of the social correspondent for Bloomberg Television. But listen, the president is obviously going to get the grilling from the comedian that will be there, as he did last year.
Roy Wood Jr.
Presidents, yes, and presidents before him have had. But really, obviously, what the press is going to be looking for is, I think, how the president acts, what his speech entails. But he's not just now the U.S. president. He's also a candidate for 2024.
Yeah.
So there's a little bit of a different lens that everyone will be watching him this weekend.
What is the lens of the president for May? How does he advocate his candidacy without actually being overt and running?
Well, he's just going to be acting as the commander-in-chief. He obviously domestically has a big battle ahead of him, which from my conversation with Kevin McCarthy, the Speaker of the House, he is not backing down, wants to get the president in the room, wants to find a compromise. But of course, the White House is saying that they want to separate anything has to do with budget and spending cuts with a clean debt ceiling bill. That's what they want. And Speaker McCarthy says that is not going to happen. That's one of two of his demands. And then, of course, the president is going to be out on his foreign policy talking points. He will be at the G7, and then he's going over to Australia for a Quad meeting. This is a moment where he could show that the United States is leading when it comes to places like China. These are going to be 2 very big moments for the president. And in these kind of places, he's going to be acting like president, but he'll be on display as the candidate for the Democratic Party for 2024.
Over the past 24 hours, you've been speaking extensively with analysts and people in the Beltway about whether this Republican agreement makes it harder or easier to come to some sort of compromise. What's your sense?
Well, the Republicans will tell you that they're the only ones that have actually done something. This is what Kevin McCarthy's entire point is. He says the Senate hasn't done anything, the president hasn't done anything. We've actually passed a debt ceiling bill. It just has spending cuts in it. And for them, this is their opening salvo to really get in the door. The issue I think that many people are looking at, and I pressed Speaker McCarthy on this, is There's reporting that he said to his members, especially the Freedom Caucus members, that they are not going to get rid of the red meat of this bill when it comes to the compromises. Now, Punchbowl News is reporting that there was no such concessions made, and then Speaker McCarthy said yesterday the two things is he will just not raise taxes and he'll not pass a clean debt ceiling bill. Everything else is up for negotiation. So I think what happens now is if there was to be a common sense compromise, this is what Senator Manchin is calling for and also urging the president to get in a room with the Speaker. If there was to be a common sense compromise, can Kevin McCarthy get Republicans behind that? What could happen is that it has to be passed in a bipartisan fashion. Democrats are going to have to sign up for it in the House.
Anne-Marie, we just had Seema Shah on, who told us that everyone outside of the U.S. doesn't care and has moved on from this. So let's move on briefly. As we do deal with some other issues, there seems to be a shift in tone in the U.S. recently when it comes to China, where suddenly you have Jake Sullivan saying that the U.S. wants to de-risk, not decouple from China. And Trade Representative Catherine Tai calls it an economic misalignment and it needs to be right-sized. Is there significance to this change in tone?
I think what we've seen over the course of the past few weeks is that the U.S. wants to make sure that they are setting up a pathway to engage with China. There are a number of big issues they need to deal with China when it comes to climate change, when it comes to making sure the militaries are talking to each other, when it comes to trying to get Xi Jinping to properly engage when it comes to a peace agreement or ceasefire, and that's going on in Ukraine, making sure that he is not sending lethal or unlethal weapons that could be material that could be used by the military. So the United States obviously wants this engagement. There also probably is a lot of concern that the U.S. is losing the global south, and Xi Jinping is potentially picking that up. So there's been a lot of hot rhetoric, and it does seem like they're just trying to bring the temperature down.
Just one final question from us, Anne-Marie. A little bit later on this morning, that report from the Vice Chair of Supervision of the Federal Reserve on the failure of SVB, how important is that going to be for you and the team a little bit later?
Well, it's incredibly important, but it comes at a time where we're trying to figure out what the U.S. government potentially will do or not do when it comes to First Republic. So obviously, there's going to be a post-mortem of SVB. At the same time, you have the House going after the San Francisco Fed. They have subpoena power in this committee, and they want to hear from Mary Daly over there. And then on top of that, we're also waiting on what's going to happen with First Republic. The reports that potentially there could be this private sector deal. It was just a month ago, I was first one to report that Jamie Dimon sat with Treasury Secretary Yellen. Do we see a repeat of that? So it's an interesting time, I think, for this report to come out. See what happened with SVB while we await for the future of what happens with First Republic.
AMH, thank you. Looking forward to your coverage with Joe Matthew a little bit later on Balance of Power at 5 p.m. Eastern Time. They'll be catching up with the former FDIC chairman, Bill Isaacs, so that's going to be an important conversation, Tom, on these issues. Lisa?
Well, I'm just looking through some of the reporting, Reuters reporting a couple of hours ago that the FDIC, the Treasury Department, and others are getting together some of the private sector players to see if they can quickly negotiate some sort of deal. It seems like it's not going well because they're bringing in more and more players, whether it's private equity, whether it's direct lenders. A real question here, though, is, well, I don't know about that, but the question still here is, are they going to participate in terms of some sort of guarantee backing this?
I hate to pick on one individual and mention them by name because there have been so many failures all over the place. Mary Daly, really haven't heard much from the San Francisco Fed president whatsoever on this issue, Tom.
Or from the chairman.
Or from the chairman himself,
I agree.
Fed Chair Jay Powell. I'm with you.
And I think everyone knows I'm a huge fan of Mary Daly, but I've been thunderstruck by the silence.
A lot of silence from the regulator and from First Republic themselves, I have to say, for the week so far. The equity market a little bit softer.
big ideas. We show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Welcome to the program, live on TV and radio. This is Bloomberg Surveillance. Your equity market negative on the S&P. On the NASDAQ, we're negative 0.2%. Amazon getting lots of attention for good reason. It was absolutely flying after the close yesterday, initially, when it reported results. And then it offered you a little bit of soft guidance around what the momentum looked like from Q1 into the beginning of Q2 on the cloud business, and maybe a little bit softer than anticipated. That stock took out pretty much all of the gains overnight. So that might weigh on the NASDAQ. Look out for that a little bit later on this morning. In the bond market, the 2-year, the 10-year, the 30-year, we look like this. Yields come in a bit, down 5 basis points on a 10-year, 3.47. The curve flattening here. We're down 2 basis points on a 2-year yield to 4.04%. Going into the Federal Reserve next week, looking for a 25 basis point hike, and then what? Then what? Well, maybe then this. Morgan Stanley looking for the Fed to communicate what they call a conditional pause. Big conversation in the news conference, no doubt, about that with Chairman Powell next week.
What is a conditional pause?
It means a pause which is conditional, Tom, on incoming information which might lead to cuts or hikes. Does that help you? Instead of a committed pause into year-end, regardless of what the data looks like.
He's loving it. Look at that.
This drives him nuts.
Yeah,
is it conditional-ish?
The problem is, Tom, and this is a big issue with this Federal Reserve, they've explained what they would like to do implied by their projections. Do you trust them? I think that's the issue. And there are some people who believe that once inflation looks like it's got a 3 handle, they're just going to back away and maybe move away from the effort.
I think people are getting bored with Fed prognostications,
you
just
think?
simply because
I totally agree.
Hold on a second, but partly because they have no inside knowledge. Maybe the senior loan officer survey could change that if it's, hey, we actually got a sneak peek, and let me tell you, it doesn't look good. We're not going to hike. You know, that would actually get some people's attention. But other than that, what guidance can they give?
We want the event, don't we? Up front, all at once.
Yes.
Special on a Sunday evening where you sit around and say, that's it, that's the future. We've decided. It's foretold. That's not how this stuff works. It's a process. It's going to take weeks, months, quarters to get this information.
I know.
Everyone wants it up front.
I know.
Let's see the credit crunch now. That's not how it works.
And if it doesn't happen, then people basically say, well, it's over, so now let's go buy. Well, what you are seeing in terms of buying and selling this morning, Amazon shares. And really, it's not necessarily that the action is so incredible. It's down 2.3%. It's why it's down and how big the swing has been. More than 14 percentage points up and then down after people found out that momentum had slipped, to use your phrase, John, in the second quarter. This question around cloud computing and how much their AWS is perhaps losing share or not at least gaining as much as some of the other cloud competitors. Pinterest, interesting to watch. And the bigger story with Pinterest and Snap to me is how much is Meta consolidating the market share when it comes to ad revenue and actually stand out rather than being just simply riding the macro wave. Pinterest falling significantly, 14% after talking about a weak forecast. Snap also missing expectations with revenue and seeing that to continue going forward. Really interesting whether this divergence only widens as people really look to advertise only on the most dominant places. In Intel, this is interesting. This is about a very low bar, clearing it, and just saying things might look okay, and then all of a sudden those shares are up 6.3%. Just to give you a sense, though, those shares, John, were down about almost 50% last year, so off a pretty low base, but they're seeing some potential signs that they could see free cash flow that gets positive in the second half of the year.
Can I just say, I love how Silicon Valley executives speak, talk about issues. This is how Snap described the advertising backdrop.
No.
Continued disruption in demand for advertising. What is a continued disruption in demand?
John,
Why
you're
can't you just say demand was softer? I mean, what does that mean? Why does everything have to be disrupted? What is disruption? What is,
because they took a, why? Because they
this?
took a course at a let me answer this. They took a course at a fancy school. They were told to read Clay Christensen on disruption, but they never read the book. That's why.
Well, it also implies that it will come back.
Sure.
Disrupted, not necessarily stalled out. And that, I think, is the distinction. But I could argue, is it disrupted because Meta's grabbing your market share? Or is it disrupted because, you know, something larger that's not going to come back?
It's a transitory soft patch.
It's a conditional.
Sure.
It's a conditional decline.
It's a conditional decline. A conditional pause, Tom.
If you live the
That's a better
study of
research, sure.
disruption, which many do, you do it at Babson College, and that is the land of the great, late, hugely missed Clay Christensen. Urian Timmer joins us of Babson, of Wellesley, and of Fidelity of Boston this morning with exquisite technical analysis on where we are. I'm just going to cut to the chase. Within your first 5 charts for FMRCO, you say we've been in a 10 months no man land. When do we know we're escaping up or down our 10 months no man's land?
Yeah, so we all know how the cycle began, and we all want to know how the cycle will end. And will it end with the Fed, raising rates one more time next week, and then pausing, which I do think is a likely scenario because we know from history that the Fed raises rates to more or less at or above the inflation rate, the trailing inflation rate. And so the core PCE is at 4.6, presumably on its way down, and the Fed is now near 5. And of course, the TIPS break-evens are somewhere 2 to 2.5. So on that, by that measure, the Fed is well above the neutral rate, if you will. So I think for the Fed, it's mostly a question of how quickly do they go back to neutral, which would be around 3%, and my guess is not very. And then the other question is about the earnings front, right? So the market is pricing in a modest contraction in earnings. So there's your modest mild recession, scenario, which I do think is likely second half of the year. But the market's very capable of looking through that, of course, as it always does. And so by that measure, we could see a 40% expansion in the multiple at some point, and the expansion at the bottom in October was 15, and so that gets you to 21 times next year's earnings of 225, 230, gets you back to the new high. So that's the glass half full scenario where the market deals with the Fed, deals with a modest slowdown or contraction in earnings, and then a recovery. And obviously, the big question is, how good are those earnings forecasts? We know that the consensus numbers tend to be optimistic, and so far the numbers for this quarter have been okay. But that becomes really the main question. But if you look at the internals, right, the S&P 500 equal weighted index has gone nowhere in 10 months. The small caps are at the lows, micro caps are at new lows, but the mega caps are at recovery highs. And so the market has been all over the place, and this, these trading ranges, now 10 months old, and back in 2015 it was from August 14 to February 16, 94 was a trading range. So if a trading range is all we're going to get, after all of this craziness of the last 3 years, little bubbles because of financial repression and then a massive rate reset, then I'll take that as a win. But the earnings need to, the market can look past an earnings valley, but it can't look past an earnings abyss. And so that really is what it comes down to.
Lost decades aren't unusual. We've seen them through history and recent history as well. Look at Japan as an example of that, and other areas as well. European banks for much of 10 years did basically nothing. When you look at the US equity market after what many people consider to be a bubble that's burst, do you see the potential for a lost decade in equity market returns at the index level in this country?
Well, we had one, of course, in the 2000s, the 70s, the 30s, and 40s. I call them secular bear markets. And secular bull markets tend to last about 18 years. produce about an 18% rate of growth, and secular bear markets tend to last about 14 years and produce basically zero growth or negative real growth. And so one of the big questions is has the secular bull market that I think started in 2009, has it ended? And it would be a shorter than usual one, although the one from 1921 to 29 was very short and extremely powerful. So when you look at valuations and you look at the new inflation regime, assuming for a moment that it's going to be above the Fed's target zone, and you look at interest rates possibly having made secular lows, that would argue for a more modest valuation regime, which would go in line with kind of a secular bear market. But to call it another lost decade, I'm not prepared to go there yet. A lot of that does come down to financial engineering and converting earnings into share buybacks. So that's been an extremely powerful engine, as well as M&A, right? If you go back to the end of the financial crisis and you look at the supply and demand of shares by corporates themselves, IPOs and secondaries, about $2.5 trillion of supply. M&A and buybacks, which is the retirement of shares from corporates, about 8 times as high. So it's been a massive imbalance of the supply of shares and the demand for shares, not even counting end investors. This is just the corporates. So if that if that engine keeps going, then I think the bull market stays alive. But if a higher rate or a tighter Fed regime kind of slows down that train, then I think there's reason to think that it could be otherwise.
Just quickly, is a 60-40 portfolio going to work in a higher inflation environment with slower growth?
So I've looked at this going back 150 years, and when the inflation rate trends or is sustained above the historical average, which is 3%, then the 60-40 doesn't work. The 40 does not, is then positively correlated to the 60. So the question is, we were at about a 2% regime. We're now at about 2.5 if you look on a 10-year rate of change basis. So it really comes down to whether the inflation situation remains structural or transitory. And it's interesting. I just did a deep dive on the 1940s. I read The History of the Federal Reserve by Ellen Meltzer. And they had 20% inflation in 46 and 47 when the price controls were lifted. And at the same time, the monetary growth started to reverse. And so it really was transitory back then. And, the kind of the post-COVID pent-up demand versus the post-war, there are some similarities.
There's some similarities there, and then we got to deflation. Eisenhower's true deflation at 52, 53, and then, John, that gets you to 2 to 3% interest rates right now. Do you predict a follow-on disinflation, deflation?
Well, I mean, the monetary base or the money supply numbers have rolled over, which is what they did in the second half of the 40s after obviously expanding rapidly from 42 to 46. And then once the price controls were lifted, you had a one-time price shock. And so hopefully this was a one-time price shock. And if so, then the inflation averages go back to kind of the historical average, and then 60-40 continues to work. And, the 40 this year is sort of doing what it's supposed to be doing. So
this was a clinic. Tom Keene.
This is what you get from Urian Timmer.
Urian, thank you. It's good to see you in New York too. Urian Timmer there at Fidelity Investments. Your equity market negative 0.3% on the S&P 500 at 8:30 Eastern Time. That's about 50 minutes from now. Nita Richardson of ADP reacting to this morning's economic data.
Keeping you up to date with the news from around the world. With the first word, I'm Lisa Mateo. Speaker Kevin McCarthy is putting the pressure on President Biden and Democrats to embrace his plan that was passed on the House floor in order to avoid a debt limit crisis. In an interview with Bloomberg TV, he said the president is putting the economy at risk by avoiding a negotiation. Biden opposes the measure because it includes sweeping spending cuts in order to raise the debt ceiling. In China, the Communist Party's Politburo said the country's economic recovery needs continued fiscal and monetary support. It also warned that domestic demand is insufficient. The Politburo is the top decision-making body led by President Xi Jinping. It's another sign of improving relations between the UK and EU after years of acrimony over Brexit. Now, Bloomberg's learned that the Chancellor of the Exchequer, Jeremy Hunt, is planning to attend an upcoming meeting of European finance ministers. Lazard posted a surprise loss in the first quarter and warned that layoffs are on the way. The asset manager says it will cut about 10% of its workforce. As of the end of 2022, Lazard had a little more than 3,400 employees. The firm blames its performance on slow M&A activity. And in sports, Lamar Jackson has become the highest paid player ever in the National Football League. According to multiple reports, the Baltimore Ravens quarterback has agreed to a 5-year, $260 million deal with $185 million of that guaranteed. Jackson negotiated the deal on his own without an agent. Gotta love that. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Free cash flow has been a problem for Amazon the last couple of years. Last year, they had $12 billion of free cash outflow. And really, there's three things driving that. One is obviously weak profits. And so we're starting to see some improvement in operating profit coming through, but it's very slow. But, you know, inflation headwinds should ease.
That was Stefan Stawinski, the global software analyst at BNP Paribas, a little bit earlier on this morning, following numbers out of Amazon to wrap up big tech for the week at least and push ahead to Apple next week. Amazon came out with what looked like decent numbers. The stock rallied hard after the close yesterday in the post-market, and then all of a sudden rolled over as they signaled a loss of momentum coming into Q2 and maybe a softer April for the cloud business. Amazon down by about 2.4% right now. The last of the big tech players, Tom, to report this week, and the guidance not great. Let's put it that way. If you can call what we heard yesterday guidance.
Yeah, I looked at Joe Feldman over at Telsey Advisory Group, and his not caution, but he pulled back, as Lisa said, up 12%? They were up.
It's a big move, yeah.
Negative 2%, and Joe Feldman had that tinge in his note as well. It was about the cardboard boxes we all get at our door, but it was about, as a general statement, a halving of the growth rate on cloud.
Connection lost. Maybe. Continuing into May, June, who knows?
Well, that's the granular, but what's the longer-term view is maybe more where we want to be on this. Right now with this, Anurag Rana, senior technology analyst for Bloomberg Intelligence with massive street cred on the cloud as well. What's the number one thing people, financial talking heads with bow ties get wrong about the cloud? What is it, we all said the cloud and this, and what do we get wrong?
So it is the next wave of however you're going to build applications. It's just a very simple way of saying that, that is the Ferrari where everything is going to run later on. Now, the question is, are you investing in that right now, or are you going to wait a little bit? Now, we talked about growth rates. Going into the quarter, they said they will do 14% in Amazon in constant currency, and the next quarter consensus figures were 12%. They did 16 and guided to 11, and that's what really caused a big mess. And, we've been saying for a while that part of the magic of cloud is that your cost structure becomes variable compared to a fixed cost structure as an enterprise. And that is another big driver, growth driver in the long run.
So talk to me a little bit more about that. Are you saying that basically these companies don't have much clarity about the future in the way that they used to? Is that how you'd explain it?
Yeah, it's the Amazon businesses, yes. But that's the question is, we don't have that much clarity over the next 6 months. I have a very good clarity for the next 5 years. I'd have no problem, sticking my neck out and says, this business over the next 5 to 6 years will double from where it is today. I'm very confident in that statement because majority of tech spending, over $2 trillion of that, still resides on large companies and their internal data centers. That's where a bulk of the applications are. And that's where the big movement is. And again, you can't run generative AI on older infrastructure.
So this is as an industry group, but what about the specific sectors? What about the specific players? And I think about Microsoft delivering better than expected cloud projections, as well as what we saw from Google. Alphabet also saw profits for the first